we were speaking about, he sees the AI, he sees the AI as a bubble. This was a few months ago. He was telling me that the AI bubble, I was like, what are signs people can look for a bubble in the AI? And he said, well, one of the things people can look for will be SpaceX, OpenAI, Anthropic, all coming out and going public. Because once they all come out and go public, that'll be a lot of capital. He said pretty much most of the capital is exhausted. One of the signals that you look for. So we're not going to get too deep into whether it's a bubble or not, but we are going to talk about these IPOs. A couple things to note with IPOs, like lately, vast majority of IPOs are down like 12 months after their listing date, right? So think about SpaceX, some of the gains we saw in it, 220 post-IPO, but 135. So I guess technically you could see it hit 65. No, the 60 levels, or it could surge back to 200. SpaceX is a little bit different when it comes to that. SpaceX has the cult following. The cult following, so like from Tesla, some of the original retail investors, like GameStop, meme stop type things, were like Tesla investors before GameStop and meme stops. So, and if you live on this planet, you know that there are few people as diverse, and not even from, well, maybe from his actions, but we're not getting into his actions, but that people have such diametric views of than Elon Musk. Some people will continue to buy this stock because it's Elon Musk. Some people will never buy this stock because it's Elon Musk. That's for each his own on that one, Main Street, but you would have a lot smaller pool of stocks to choose from if you invested based off the person that runs the company. I'll just leave it at that. But another thing that came out with SpaceX, people were expecting SpaceX to buy Tesla, which could still happen, but SpaceX has the government contracts and the SpaceX wants to buy Tesla. And this was a reported or a leak. Elon Musk actually denied it, that Tesla would be divesting from its China interests in some sort of separation or some sort of pulling apart of the company. That word's leaving my brain right now. But like, well, Honeywell did it, GE, Verona did it, or you break it down for the sum of the parts. But they could do something like that and then leave the interest in China, and that way you wouldn't have to work with security interests. But Elon Musk said that had not ever been reported or ever even talked about, and that was falsely reported. But we'll see. I think China has a different type of set of rules if you want to leave China, or maybe you want to stay in China. Either way, I think China has a little more control on their companies than America does for now anyway. But like we said, we got OpenAI and Anthropic preparing for their public listings over the next 12 months, and people really talking about the circular investments again. It's part of the reason why we saw companies like NVIDIA take a big hit here recently. We saw tech giants that are investing in NVIDIA actually made another investment into, I think it was Anthropic earlier this week. Discussed that deeper in one of my videos from earlier this week. But yes, we see that right there. And people are wondering where exactly this money going to come from. Where's this money? How's it getting back to for this cloud computing? How much it's going to cost? And then you have reports coming from China where the Chinese companies are building these products out and building out these same type of things for fewer costs, less tokens, cheaper type tokens. Because now it's becoming about tokens and tokenization. Cost of tokens, cost per token, what kind of quality are you going to get from your work for a token? When they first came out, I realized it was about tokens. People were buying tokens and token maxing, and then I think corporations just say, oh, that's really expensive. We need to pull back here and figure out a more efficient way. And then, like I said, you see the China companies coming out over there with models that are just cheaper models. I think we saw, maybe it was Alibaba giving some NVIDIA chips to some companies in China, smoking some over there to some companies in China, and they just build off of those NVIDIA chips to grow their AI companies. So like go in there, clone them, and increase their AI capacity. Obviously at a cheaper price. I mean, if you're getting free, it's pretty much a lot cheaper than what they're paying. So you have that circle investment. We just saw people a lot of concern with AI and the AI build out. And then also with the way AI is financed, and we saw the leverage go into effect from the private investor who Ken Griffin and the CEO came in to quote unquote save. His fund was up to like $45 billion, but it was so highly levered. I think they probably sold it for parts for like $10 billion, and I say that like that's a little bit of money. And who knows what Citadel's going to do with it. But I'm sure Ken Griffin has a plan for it to make multiples on that investment versus what they paid for it. But it was highly levered into like memory stocks and into the Kospi over there. And when it worked, it worked. But when it stopped working, Like these are rotations and these are the realities of the market. Like when it stopped working and when it has that much momentum, it's just whoosh, you can be hit really hard. People's life savings, their trillions of dollars just wiped out. Speaking of trillions of dollars been wiped out, like an example. So when SpaceX first came out, it initially made Elon Musk a trillionaire within like the first week, maybe like within the first weekend, they bought a company for like several hundred billion. The company they bought actually was pretty much the same amount of market cap that they had gained in stock price over that time, which is interesting in itself, before the stock went back down. But they're taking some of that money and we're buying other things, growing that company. Like I said, this goes back to circle investments maybe. But here we are, and we're at the equal weight, like how the markets are moving. Capital is moving away from that hyper concentration back to equal weight indexes, one equal weight index. And this is a stock recommendation. None of these things we've said, just to repeat, are stock recommendations, but they're just stocks that you can look at. So capital is moving away from the hyper concentration. Small caps have been leading for like over a year. I don't think people realize that. Small caps have been running. If we do get rate hikes, that could definitely do something to the small cap rotation that we've seen, because higher rates will impact smaller businesses more than they will impact larger business. We recently saw 50 tariffs implemented on Canada. So how will these be passed down to corporations, to consumers? And then, we got the debt wall going on. So we got the metric flash. One is signs $40 trillion. And then that serviceable debt's like 160 trillion. So a lot of debt that we have to service right now, which ties back into the interest rate conversation that people are having. Will we have lower interest rates, which will make it easier to service the debt? That's why people ask, will we have lower interest rates as well? Make it easier for people to buy homes. And these are all in theory, with the rate cuts, right? Because the truth is the Fed cut rates several times under Jerome Powell and the stock market went up. So you had several rate cuts and then you had the stock market go up. So where is the stock market going? Think you're going to see more bumps in the stock market and volatility until we reach the election. Then hopefully we have some clean, clear elections that can carry us in and through the stock market. Once the stock market has clarity, I expect it to go up. But we'll see what happens in between now and then. A lot of volatility, a lot of things are happening. Like I said, we still have a war happening right now. Tariffs are coming back. How are these tariffs implemented and impacting the world? How's inflation hitting consumers? Which one of these big companies that everyone's banking to win is not going to win? We'll see. Or who's going to zero? Someone's going to zero. We haven't even talked about crypto. Crypto's a thing that seems to be coming back as well. But there's a lot going on. And then cybersecurity, right? So we'll talk about a little bit about cybersecurity. Over the last few weeks, we've seen Anthropic's model, I think it was Anthropic's model, hack into other places, hack into other companies, hack into other models. Hugging Face is one that hacked in, and it's doing this outside of the perimeters that it's being trained to do, right? There you go. Claude Anthropic, right? Yeah, so Hugging Face goes in there, and then I think as recently as yesterday, they announced like 3 more interfaces that were breached. These AI models are supposed to be in sandboxes, but they're getting outside the sandboxes. The first one it was supposed to be a test, but the AI model decided that the test was too hard, or maybe it just decided there was an easier way by going into, instead of solving the answers for the test, just go to the source for the test. So one thing to think about with that is, back in the 80s, 90s, Microsoft really dominated the world because it had enterprise like software that people could put on the computer, and it was in everyone's operating system. Pretty much, you had to have Windows for a while, a monopoly. I believe they got sued for it. If I remember correctly, Microsoft got sued for that. Could cybersecurity be the next layer like that? And there's a company that's leading like CrowdStrike. Well, is that going to be like the next Microsoft? Once again, not investment advice, not a single stock recommendation, but is CrowdStrike or Zscaler or Palo Alto, is that a company that's going to be like Microsoft? Now we're seeing the increased need for cybersecurity, especially with large amounts of capital, not to mention a company like Palantir. Palantir is really deep with government contracts, and they're so layered inside defense and cybersecurity. Maybe they could be a winner inside of this movement to cybersecurity, but cybersecurity stocks also they go strong with software. I don't know if people remember back in February where we had that SaaS apocalypse, and it just kind of became a rotating SaaS apocalypse. Cybersecurity, financials, every industry. I think the trash industry got disrupted 1 week because of something with AI. We saw all birds go from a shoe company to an AI company. So just rotating AI bubble popping around, right? And that's another thing. That was another question. Like I said, people ask me, was a bubble with AI. And I would say, I actually did say, so this is how I describe it. I don't think it's a bubble per se. If it is, we're all in and we all know it. But it's like a building. I got even deeper into my thought about it from where I answered the council. So it's like a building. It's like when you're building a building as well. So you gotta put like the frame in, and I don't build buildings, right? You gotta put the frame on the side or whatever you're going to do, but you gotta put up the four big walls outside. However big the building is, right? You gotta have four walls. So like the AI, in my opinion, is like, so far as the four big walls, this is a huge building. Then they're going to break off into different sections, like rooms inside the building, and that's what's happening inside AI. So like different rooms are popping and different rooms are bubbling, that pressure's going, but it's all the same. It's all in the same house. Hopefully the whole house doesn't catch on fire at one time. So maybe that's the difference to what we're seeing right now. So is it a bubble? If it is, like, we're in it and we know it. It's irrational exuberance all over again, perhaps. Is this time different? They rhyme, but they're never really different, right? But they're always different. They're different calices, I guess you should say, right? Whether it be the 87 crash from that stock market just running hot, whether it be, the 99.com bubble where that stock market went hot from everyone thinking that the internet was going to change the world, which it did. I mean, if it wasn't for internet, we wouldn't be sitting here doing this right now and having the AI conversation, to the housing bubble, which the world knew about. Well, not the world, but people definitely knew. They were putting together trash products and junk and selling them, and they were essentially betting against the products that they were putting out. I digress. That really ruined a lot of stuff for people of this generation right now. There are a lot of people who were children in '08 and saw their parents lose their houses and have to move or lose your jobs or get divorced. It's just a lot of things that came from a situation that could have been avoided. You just can't give subprime mortgages to everyone. People who can't afford it. And then we have to know where we're at inside this bubble and be positioned properly. Okay. We talked about concentration risk. I spoke about concentration risk inside this conversation as well. Like inside your portfolio, anything you're investing in, you can't have a simple way of saying is you don't have all your eggs in one basket. What do you think about building our portfolio, right? And this isn't once again, not a stock recommendation or plug for Apple or any individual stock, but Apple seems to win, right? We talk about why Apple wins in the long run. There's an article right there in the video right here. And once again, this is all in the newsletter that I wrote for LinkedIn. It's a long newsletter, but this is the article on X right here that we're reviewing. It's just reviewing the markets in the month. But Apple wins in the long run. Not a recommendation for Apple, for or against Apple, but why does Apple win in the long run? Like, just think about it. Apple sent me a message the other day, said they were increasing my Apple Music price, and I didn't cancel my Apple Music or my Apple monthly subscription. They only increased about $1, right? So we're in here and we're sitting in a water bowl. We're going to jump out. I don't know. We'll see. Everyone else was spending so much money on CapEx, capital expenditures, right, last year, and Apple stock was being destroyed for it. Being destroyed for the capital expenditure because they weren't spending money, right? I said it to other people. I said it's a good bit, like the early bird gets the worm, but the second mouse gets the cheese, right? And Apple may be the second, third, fourth mouse, right? And I got a video on this from earlier this week where I go deeper into Apple and all these things, well as why they win in the long run. And they just reported and their stock actually went down. So maybe that's an opportunity to look at a stock like Apple. And it doesn't just have to be Apple, but we are going to talk about Apple right now, like Apple specific. But people were being rewarded for spending money last year. And now we see with stock, people are being punished for spending too much money if they don't have a clear plan of where that money is going. So they were burning through their cash on data centers and free cash flow. And Apple has a fortress of a balance sheet. Apple has more cash than a lot of countries in the world. Like Apple would be one of the larger economies in the world just based on how much cash that corporation has. Apple has so many levers and so many things that they can pull, so many things that they have invested in, Apple phones, Apple devices, Apple subscription, Apple TV, just so many things with Apple. And then just to bring in with Apple, like half the world's already built in as Apple users. The people use on Switch. So then they have the partnership with Google. And see, this this is another thing. People hear these things. This is all on the media right now, like the mainstream media. There's Apple stuff. Go get Apple. Go get Apple. Go get Apple. But other people have been talking about it. I was talking about this Apple for over a year. I've been talking about this for Apple for like well over a year. Pretty much anytime anyone asks me about Apple, I'm like, yeah, it's probably not a bad time to invest in Apple. Once again, not a stock recommendation, but reasons why, and people say Apple's price high, it's priced over the market multiple, like 35, 37, 38. Well, Apple's a premium. It's the most valuable company in the world by market cap. So you're probably about to pay a premium for that. You pay a premium for premium products, but you also should expect a premium return, which Apple had not been delivering for a while. A premium return, like I said, we saw the stock trading sideways and trading down, but now it's been one of the better performance this year until recently in the report. And I was asked a question on South Korean TV, K-Pro TV, earlier this year, asked about, and Apple or Alphabet. And like I said at the time, it's hard to go wrong with either one of them, but I do like Apple. And this was the time when Alphabet and Apple had just went to their strategic partnership. Apple was paying Alphabet. Apple is paying Alphabet as a subscription fee for them to use it. But at the end of the day, you got to realize that it all comes back to Apple, right? People always come back to Apple. All of these tools, all these platforms, whatever OpenAI is building, it's going to be on Apple. All these AI interfaces, the Uber app, whatever you're thinking about is going to be on your iPhone. At the end of the day, people just want to tap that app and get to it. So the App Store is so powerful. Apple's not all rosy, right? Like I said, you have the multiple that's above the market level. So there are definitely opportunities with companies with lower multiples, although the multiple probably came down some with the price depreciating this week from the stock selling off a little bit, but it had been on the run, a great run. One thing to look at is the leadership transition Apple has coming in. Tim Cook is taking his final earnings call. That was that was Wednesday. So the next one will be from John Turnus, who comes in September. Watch out for his expansion plan. We'll see. Like I said, Apple has already built in a lot of user base. Apple didn't spend a lot of money on AI. Apple has kind of said a couple of things that they want to kind of do now with AI, maybe playing some stuff with Siri. And Apple's hardware failures have been of note here lately, right? I think the 17 got a better response than most people expected, and now they're launching 18. So perhaps with those product launches of the hardware, we can see some appreciation as well, like see some growth towards earnings in Apple. But you also have to remember Apple, and people were calling for Apple to acquire something last year. Why is Apple not buying this? Why is Apple not buying that? Apple hasn't really been making a lot of acquisitions. They have had a lot of brain drain, so a lot of people leaving from the top. But Apple was built to last. People thought that Apple was going to be, dead in the water when Steve Jobs passed away and Tim Cook took over forth. Because you have Steve Jobs, who was a visionary, and you had Tim Cook, who was a supply chain guy. Turns out you need a supply chain guy for COVID, right? When the whole world shut down, you needed someone who could navigate supply chains. That's one of the reasons we saw Apple continue to not just survive, but thrive when that time they had stock split. I remember stock was down like $100 when they did that split. So Apple's a strong play. Once again, not stock recommendation, but find a stock if you are looking for like a stock, some type of stock. Find a stock like that, right? So that's what I mean by like find an anchor stock. Find some stocks that you can grow on. And if you've never invested, you probably should base it on some type of index or ETF that mirrors the market, right? As a big part of your core position, right? Think about like you have a jar. You got rock, big rock, that is most important. And you have little pebbles, and you have sand. Pebbles are kind of important. The sand is just like frivolous stuff, right? You want to fill but all of it makes 100% of your portfolio. I don't want to say frivolous, it's smaller, right? You got to figure out how to fill that jar up, which the lid's going to be smaller a little bit than the rest. It's going to be kind of shaped like that. So you got to figure out how to fill that whole jar up, right? If you just put the big part in, you just put the rock in there first, and then you build around it, are you going to be able to get everything in there? So maybe you want to build your base with a little bit of that sand, right? Because the sand's like small caps, right? So you have a little bit of that sand in there. Then you put the rock in there. It's taking up a lot, maybe some large cap allocation. And then you put the pebbles around it, the mid cap section. Then you got a whole portfolio in there. You got everything inside the rock. And it's not over proportionate. But like I said, if you're doing it with like market indexes, something that's just mirroring the market, that should take care of that for you as far as like diversification. Make sure that you have everything inside your portfolio. Because once again, with Main Street meets Wall Street, the conversation we have, trying to give you actionable steps that you can take and things that you can do, ways that you can grow, like things you can do today, tomorrow, like things that you don't have to wait and do, things that don't seem so downtrodden for people, right? And then, like I said, so back to equities, capture the headlines, but bond market, good brother, right? When Walsh was speaking, Treasury yields pushed higher. The bond market looked at the Fed and essentially said, man, you can say whatever you want. You keep talking about that 2% target, which you hadn't hit in 5 years or longer. And, inflation's the closest it's been has been in the threes, right? Low threes, maybe it touched some high twos. But Kevin Walsh also said his inflation numbers, he's looking to the left of the decimal, so he wants that too. Then he said, so this is more of the Walsh talk that we're getting, that he is concerned that when he says 2, I think he means 2.0 for the inflation target, different from the first speech versus the second speech he gave. But we had the huge stimulus injections, pretty much across multiple presidential administrations for decades, right? Like, let's be clear on all that. It's not just Biden and Trump who did that. And now people are going to turn to Jackson Hole in August to see, which isn't, quote unquote Fed meeting, but he's definitely going to come out and say something. As Walsh said that he would speak for the Fed, committed to give speeches for the rest of this year. He will reevaluate after that. So he'll speak in Jackson Hole. He'll speak at the September meeting. I think they have maybe 2 more meetings after the September meeting. So he'll speak for those. But the market should adjust to like Kevin Walsh's style right now. That what Kevin Walsh is saying is not, he wants the market to take care of it. The market's going to make the Fed do something. They're not just going to sit here and keep letting Kevin Walsh make the market take care of it. So it'll be interesting to see. But you got to maintain proper position. You got to schedule your money dates, folks. And you got to be in this for the long term. Don't let the short-term noise and short-term signals distract you from what you're doing, from where you're trying to get to in life. From the goals that you have, from the economic principles that you've based on your plan, unless any of that's changed, stay in there. If anything, maybe you need to double down when turmoil comes in the markets. Because guess what? Every 5 years or so, you're going to lose a decent amount that you hold. Considering if you've been inside this market the whole time, you've just been watching it go up, it's going to feel like a real big amount. But what you have to do, and this is where financial professionals or someone else can help you generally, it's hard for us to have that mindset alone, is you have to remember why you're invested. And if you stay invested, history's shown us, I can't speak for the future, but history has shown us that if you stay invested through these market downturns, and when market downturns happen, you'll be rewarded markedly on the other side, like multiple. We've seen some generational wealth. Like I said, I walked into the room and I said, Marcus Sturman Sr., drove down here from Wall Street South, Charlotte, North Carolina. And I was in Atlanta, and Atlanta folks looked at me like I was crazy. But y'all gotta watch out for Charlotte. Like I said, we got $4 trillion in assets. We got BA here. Truist is here. Wells Fargo has a big thing here. Financial heavyweights, like Truist came here when they were in Winston-Salem. Wells Fargo's got their most employees here. And then pretty much every major center is here. Even JP Morgan just came down here. JP Morgan Chase came down here. I think it was the end of last year. Saw Jamie Dimon doing an interview from Austin. This is in Charlotte. A lot of financial workforce. I know a lot of people who work in the financial workforce here in Charlotte. Charlotte's one of the biggest and largest growing cities, and our mega banks control a lot of our local deposits. So, like I said, Charlotte is just, with the Wall Street South. Sorry. It's not a bad thing. And a lot of people are like, it's what it is. Like, Wall Street South represent. That's pretty much the newsletter that we went over. Like I said, if you want to read this, it's a 10 to 15 minute read, but it's definitely worth it. If you want to go more in depth on some of the things that we're talking about. Some other things, just so you're not reading the letter the whole time, just take a few minutes to wrap this up real quick. We did get a GDP report. It came back a little bit lower than expected. So we're seeing GDP maybe contract. We'll see how that works out. But that was, we had the war in Q2. So Q2, AI valuation reality versus the actual premium that we're seeing in this market. Don't let AI and AI build out, have you over-concentrated inside your portfolio right now. Because we've seen that whipsaw goes both ways. Then we talked about estates, family money dates. Make sure we are planning these money dates, that you're sitting down with your loved one, you're preserving your wealth, you're doing the things you need to do. Y'all are having these conversations. Make sure they're structured, make sure they're really happening. Some things you can do, like I said, actionable steps. Make sure you have beneficiaries designated on your accounts. If you remarry something to that effect, make sure you have proper updated beneficiaries, because I don't think very many people are going to be happy if they pass away and their ex-spouse, while they have a current spouse, gets the stuff. So make sure you have those updated. Make sure you have rebalancing set up the way it is. make sure your generational transfer strategies, they align with tax laws. Like if you want to set up a trust, you probably should spend some money and get a trust attorney to help you set that thing up the proper way. And then just remember, like the Malcolm Jamal Warner situation, just because you have a prenup or a trust, whatever you may have, things can change and people can contest them, and we'll see how the law plays out for it. We say will oil hit $100? That's going to be a big level. If oil hits $100, and then maybe we'll see interest rates. And this isn't necessarily saying that they'll be tied together, but they could be. Oil $100, interest rates at 5% from the 10-year. The 10-year is like 4.7 right now, but we see the 10-year is like 5%. People are conditioned in their mind to go more risk off because they feel like 5% risk free is a great return. I would say, is it really 5% risk free though? First of all, everyone could default. The U.S. government probably won't. They never have not paid a bill. But if it's 5% return and then you are, let's say inflation is 3.5%, you're really only getting 1.5% on that cash back in real return, which is another reason why equities generally outperform in the long run, because you're generally going to get 7 to 10% historically on equities. Like if you look back over like the last 100 years, let's say when inflation, there's a reason why they say 2% as a target. Let's say it's potentially 2%. That's a larger real return than if your cash was getting 4%. So we'll see how it goes. We'll see how portfolios are hedging against it. We'll see if gold comes back into play, if metals come back into play for more than just the AI build out. So we'll see if like the actual precious metals become a thing. So that'll also be a sign that people are worried about money and the stock market. We've seen that dollar firm up here just continue to go up. So that would also be another thing that could be impacted by interest rates. And we're seeing maybe as the dollar firms up, people are saying, yeah, we think the rates are going to go higher for the cost of capital. CapEx, cybersecurity, right? So tech earnings, you got to look out for CapEx. We need to see where this money's going, where they're spending these dollars, where they're actually going right now. This IPO window is going to be key. We've seen several of the big ones push their announced date back to properly at the beginning of 2027 or some point within the next year, whereas people thought that they probably all three were going to come this year. Watch the earnings with the cybersecurity, right? Because if they continue to spend, it's eventually going to compress your margins. I mean, you can only spend so much with the earnings before you take it away and you're in bad shape, like really bad shape. And that could just happen overnight. So watch how these firms are financing their debt, how this debt's being financed and where the money's coming from. And what's the ROI is return on investment. And like I said, Charlotte, man, we're the Wall Street of South. Like people can hate, people can say whatever they want, but Charlotte's the Wall Street of the South. I want to take a minute and just thank people. I want to thank y'all for the people who tune in, the people who read the newsletter, people who listen to the podcast, the people who support the channel, people who pop in and say, like, share, subscribe. Like, appreciate that stuff. I want to show you the newsletter. Like I said, that was the LinkedIn version that I just showed you. I mean, that was the X version. Here's the LinkedIn version. Like I said, we're sitting 1,400 subscribers, over 1,400 subscribers. I love that picture of Warsh and Powell. And then it's the latest edition right here. So it just came out and it's a 15-minute or so read. But it also has videos in there to, help you dive deeper into some of the concepts that we're talking about. So video there with Mr. George Hoppenfuller. Sorry to go so fast. The debt, we're talking about the debt in one of the videos. It's a tranche of wealth right here, a wealth of knowledge. Ashley and I talking about couples and money, reason money and couples. That was a great conversation. 2 parts to it, actually. Then actually one with Mr. Derek Kinney. Derek has a great conversation, ways to think about the economy and volatility. You're an advisor, how to talk to your clients during these times, or how to grow your business, or whether you're just dealing with your own personal financial economy, which all of us are, right? We all have our own personal CEOs or personal financial economies that we're dealing with and that we're trying to grow. So his is great for that. And then we had a great conversation with Ryan from over at Benzinga. Great conversation. He hosts the Pre-Market Playbook show. We just talked a lot about noise versus signal. Ryan's a Bears fan, for those who don't know. AI shirt logo, I don't know why I made it like that. Ryan's a Bears, he had on a Bears shirt. But you should check it out. It's a great conversation and just some of the things they're doing over there at Benzinga. It's really, really cool stuff. I actually have a Benzinga link that I can put into leave in the show notes for folks so you can check it out. Use my link and I may be compensated, but it won't cost you anything extra. Speaking of Benzinga, there's another conversation I had with Benzinga with Brad Olson, the Chief Content Officer over there at Benzinga. So that was a great conversation as well. That may be part two with Brad. And then we talk about the cybersecurity. And then that's the video. So I was talking about a video I did earlier where we were talking about Apple and breaking down some of those companies. That's it right there. So, and also in the backside of that video, I take like the last 30 minutes to talk about just 401ks, history of 401ks, like how they were written out until like 1978. They were pretty much a loophole that someone discovered in the early 80s. Like they were only for high ranking executives. It was kind of for executive compensation is why they came about with the 401ks. And then people realized that there was an evolution and how 401ks actually meant, a good reason to push some of the onus back onto the individual. So we talk about defined benefit plan versus defined contribution plan in that video as well. So for that, just real quick, high level, let's with defined benefit plan, you're going to get X amount as long as you're going to get this benefit. Think of pension, you'll get an annuitized amount of money for the rest of your life as long as you put in this amount and follow these rules. So that's defined benefit. Whereas with defined contribution, where it's just say, if you put this amount of money into this plan, you may get this return. It's not a guaranteed benefit. It's up to you that you do it for one, that you put the money in there, and two, you pick the investment stand. So that's defined contribution, like you're defining that you contribute. It, once again, just pushes the onus back to the individual. And then right here, we have a deep dive on SpaceX IPO. That video actually has several interviews from SpaceX's, like straight from their mouth, the CEO. So yeah, Musk is talking and CFO, and they're talking about their vision. It goes through their history. So it's a good conversation right there. And then for anyone, like I said, this is the LinkedIn version. So anyone who wants to roll on LinkedIn, like how to make a good post, what people are looking for on LinkedIn, why LinkedIn is great, what LinkedIn is good for. That conversation with John Tomasi is right there on the newsletter as well. So like I said, the LinkedIn newsletter is a lot, this one. And then it also has the podcast that you can check out, link to the podcast and link to the YouTube channel. So yeah, Main Street, that's a lot. Showing you a lot here, talking about a lot. About to sign off here. We're going for about an hour now. I just want a little over an hour. I just want the people hit the like button, subscribe, share this with someone. For anyone who is yet to experience Main Street meets Wall Street, or anyone who has not heard the podcast, not seen the channel, check it out. Come through. It's football season, so we got the Raiders, Panthers, it's that time of year. Fantasy football is kicking off. But Main Street Heart, Wall Street Smarts. Like I said, check out the podcast. We have some really good people coming on. This one was live. We're refurbished. You'll be able to catch it later on. Main Street Heart meets Wall Street Smarts. Hit that like button, subscribe, share this. Thanks, Main Street. Welcome back to Main Street meets Wall Street. We're broadcasting from the Wall Street of the South, right here in Charlotte, North Carolina. I'm your host, Marcus Sturdivant Sr., owner of the ABC Squared Financial Planning Firm. I'm going to start today's broadcast with a raw dose of reality. No one's coming to save us. Not the government, not your employer, and certainly not Wall Street fund managers who collect management fees whether your portfolio goes up or down. This broadcast is for every working American, retail investor, and household CFO who is tired of relying on default. If you have a 401k, an IRA, or a paycheck you're trying to turn into long-term generational wealth, this broadcast was built specifically for you. Oh, guess what? We have a very large international audience as well, so this is a global advice, not recommendations. Today, we're running a streamlined high value to show you. First, we're going to start with a market blitz, where we'll cover macroeconomic forces impacting your money right now. Fed Chair Kevin Warsh's interest rate tightrope, Middle East oil shocks, and key stock realignments such as Apple and Intel. And then we're going to dive into, coming straight from a question, what did people do before 401ks? For those who don't know, 401ks didn't come about until like 1978. So we're going to have to stop running your financial life on autopilot. You'll understand how to capture 100% of your employer's 401k match, how to audit some of these expenses and stop those fees, build you a multi-bucket wealth strategy outside your job, track your complete household budget in real time. So hit that like button, hit the subscribe button. You can drop your city, state in the live chat right now. We're going to get straight to work. I want to just take a second, like I said, thank the folks who are joining us, checking this out live, wherever you may be watching from. We have a pretty broad audience checking us out from all over the globe, actually. It's very humbling, and it's just great to see people checking us out from all over the globe. Thank you so much for what you do and how you join in and check us out. So let's just jump in. Let's talk about what we got going on right now, right? So we have Kevin Warsh coming into his next meeting, one of his next Fed chair meetings coming up Wednesday. The market's not really giving the meeting room to lower rates or raise rates. The market and the data is kind of just leaving it, maybe data dependent, but Warsh has already said he's approaching the Fed different. So it'll be interesting to see his remarks, how long his speak is, how long he speaks for afterwards, his speech that he gives, whether or not they actually raise rates. I don't think that'll happen at this meeting, but that's been the odds of hikes continue to go up. I saw an interesting poll, or I saw it. Yeah, it was actually a poll, interesting poll showing the odds of hikes. So one of the odds of hikes, it was up at like 81% for a hike by July of 2027, but it only went to like 82% for a hike by the end of 2028. So like 6 months. If they're saying if it doesn't happen by July 2027, then it's a 1% chance that it happens. But these numbers have changed. Like I said, these numbers have changed right over since Warsh has taken over. If everyone remembers, when we started this year, everybody expected lower rates from the Federal Reserve. Everyone expected Donald Trump's new chair appointee to come in and just lower rates as soon as it happened. We knew Chairman Powell's term was expiring, and the Fed, frankly, just hasn't reached their target since, for like 5 years. They keep saying 2%, but they have not reached that 5% or that 2% goal. So the Fed struggled to reach that goal. I don't even want to say struggle. The Fed's just failed at reaching that goal, right, in the current environment that they're in. And after that, we have record levels of debt, and servicing debt. Our serviceable debt's like 160 some odd trillion dollars plus that we have to service. For our national debt's approaching 40 trillion. But when I say serviceable debt, and if you haven't seen it before, if you look back in old videos, you can see where we're talking about serviceable debt and just the debt. There's a great video on debt, actually, that I did with James Callahan, where we're talking about debt. But with the debt, he's down national debt. He's a credit analyst. He was a former credit analyst. He's retired from that now. But he saw a lot of things. So with the debt, what do you see inside the debt? And then how they can manage the debt. Headline inflation remains sticky due to these energy prices. We see the fluctuation, right? So we have the war, which could actually provide some shield maybe for Warsh to cut. But while the obligation to service it just continues to go up. So we stay at these interest rate levels. So Warsh is boxed in, cutting those rates too fast could keep this economy running real hot and actually increase inflation. But keeping rates elevated with sustained pressure, that could slow down growth, which I don't think Warsh wants to do. There are other tools Warsh could take. He could look at quantitative tightening or easing on the actual balance sheet as opposed to rates, money supply. There are a lot of different tools that the Fed actually has. And then they have Fed speak, especially when you have a Federal Reserve chairman like Warsh, who said he wasn't going to speak a lot. So his words presumably will move markets more than what people are generally anticipating from the markets right now, or what maybe even what Chairman Powell did. We've noticed also when we talk about people and not moving the markets anymore, the president's tweets and posts have started to have less effect and impact on the markets now. Every post and tweet, especially when it comes to the war, which we'll get to that in just a second, Iran war and some of the geopolitical issues they have going on there. But like I said, just want to stay with the interest rates and debts right now. For those, just a brief reminder, where we look while we're looking at this debt, because as the interest rates rise or if they go up or if they go down, I think they probably will stay the same at this next meeting, as I stated earlier. But that's a double-edged sword, right? If they go up, the amount of money that you're earning on your savings increases, right? But like I said, the cost of services debt for the government's going to increase. If they go down, it'll be cheap for the governments to service their debt. It'll be less money for individuals inside of their retirement accounts. For individuals inside like high-yield savings accounts, those will go down because those kind of attract to the markets and the Federal Reserve rate that, they got the spread inside there. But so if it goes down, it ideally is better for the government to service the debt, but it's worse for, let's say, like retirees, people who are retired or set on some type of fixed income rate. Unless your income rate was based on like the COLA adjustment, it goes below that, which it won't. It rarely does. But that's just some of the ways that, the debt and interest rates impact you every day. Also, not to mention just personal borrowing costs when you go to borrow money from anyone or anything. They usually, especially banks, lending facilities, they're going to anchor onto the federal fund rate and then add their costs on top of, because, of course, they're going to have to make a spread on top of that. The banks just aren't going to let you make all the money per se. They're going to want to see their spread. Another thing is with Chairman Warsh, he announced the personnel for his task force We've talked about that in past videos before, past pretty deep dives on Kevin Warsh and his Federal Reserve Task Force. But one is going to be communications, balance sheet audit, economic data and sources, AI productivity and framework, and then inflation 2.0. But like we said, when he mentioned inflation, he put it as a look to the left of the decimal. So he's looking at the whole number to get down to 2, maybe not the number on the right of the decimal. So maybe not like, maybe 2.9 is 2 to him is what I'm saying. So he's changing it from that side. So it's a big shift. You also have to remember that Jerome Powell is still on the Federal Reserve Board. So Powell's still there. He's just not the chairman anymore, but he's still a vote member, if I remember correctly. So Powell's still there. Warsh is trying to find his feet. Most chairmen or most new chairmen have been tested in history. And another thing, new chairmen have pretty much in recent history all had to make their first move a hike. So we'll see if Warsh somehow navigates a position where it's not a hike from his end. But from what we've seen in history, in recent history, the first move is usually a hike where there's usually some type of conflict. So, and then, speaking of conflicts, we have the Iran conflict going on. Oil prices spiked again last week, back around 100, up over 100, but with the delays or the pause in the kinetic warfare, USA stopped bombing Iran for a little while. Last few days, that could pick up any time, but Central Command didn't announce any new bombs flying over there, and the Strait of Hormuz, like I said, that's been pushing oil prices higher, so it's definitely had an impact on the stock market. As we've seen oil prices go higher, we've seen the stock market go lower, and then today we saw oil prices retreat and go back down, and we saw the stock market in turn go higher. I'm sorry, stocks were higher, much higher this morning, and then that kind of reversed. Like futures were way up this morning for the stock market, which is another thing to see. Like futures are just all over the place. The stock market. So this higher energy, like I said, that translates to everything. It costs more for people to transport stuff. It costs more for people to do anything that they want to do in life, because it's the transportation cost always comes back down to that's input costs that people are not accounting for, but the manufacturers account for. We've noticed PPI has been higher than CPI here lately. So that means, producer price index versus the consumer price index, that just means that the producers are still eating more at the cost for now. We're seeing tariffs come back into play, like at a higher level or more sustained level, I should say. We saw last week in the tariffs. So that goes into geopolitical play. I juxtapose with the tariffs that it's more, the level of tariffs definitely matter, like whether they're like a crazy, crazy high level, but like the fact that we have tariffs wherever we have them at, like some level of knowing what tariffs matters as well. It may even matter more, because corporations, businesses, they adjust to these things, right? They take their time and they figure out like these big moves. And large money like that institutional money, they don't move as fast as retail investors anyway. So it'll be interesting to see if we continue to see these increased input prices from the Iran conflict that's happening right now. We'll see what happens. We'll see if we can get another memorandum to continue this ceasefire. I don't know if it's ceasefire. I don't even know the technical term they're using right now for when it changes, the reason that we're at war changes. But there's just a lot going on over there in Iran right now. Thoughts and everything for our soldiers, the people who keep us safe, and we lost a few more soldiers. So hopefully this conflict ends soon and we can get back to worrying about the normal stuff. I say normal stuff, what people worry about with stocks, prices, earnings, all those things that are going on. Speaking of earnings, we're gearing up right for earnings season. So a big earnings season ahead of us right now. We're actually in the midst. We're about to hit the biggest part of it. We have some of those mega cap companies reporting, some of those hyperscalers in the AI build out. Will be interesting to see what they say. I think Google reported last week. Google reported, and when they reported, they let the world know they're still going to increase CapEx because they see CapEx and AI build out as something that is almost insatiable. They can't not build to keep up with it. Otherwise, they will be behind. And it makes sense if you listen to what I just said, like break it back down. But the hyperscalers in the build out, and then we had Anthropic and the Hugging Face, where one of the models went in. They set up the model to attack the cybersecurity, but based on some parameters, and then the AI model decided that it would just go in, I think, down to the root source to the test and figure out how to get the best answers, like the most efficient answers, and end up like hacking deeper than they even anticipated. So that type of stuff's worrisome, a little bit when it comes to AI. But we see some of the AI companies right now actually coming into a consortium where they're going to look to curb and model their AI output and what those models are doing. But who knows, man? Those models are smart. They're already running and generating. I don't think they're showing us everything they know anyway. But I'm not going into conspiracy theories here. We're just talking about like actual input. So it'll be interesting to see where people are at with what hyperscalers are saying with their capex when it comes to AI and the AI build out. How much money are they spending? Will Google be a canary in the coal mine, or is there a lot? Are we going to see people who can't meet their debt? We also saw Nvidia today come out with more backing for, I think it was Anthropic. They said they were going to back them longer with like $250 billion worth of credit, extend to 250 million, 250, can't remember if it's billion or million. It's a big number though. I'll have to look that one up for you. But it's a big number. I think it's billion. $250 billion. No, it's $250 million. $250 million investment. So kind of like a credit type investment if someone needs it, but it's actually coming from NVIDIA's credit sheet into their free cash flow. But the way it's set up, I mean, the company you're financing has to reach certain tranches for it can even access the credit. So they have to reach certain goals and certain parameters. And you just want to think that people are back to the circular investment. NVIDIA is inside everything, and it always goes back to NVIDIA. But NVIDIA was down today. We've seen semiconductor stocks come down, the software stocks have risen. Big thing that we've seen here lately in this market is we've seen the broadening of the market. So while you may look, and if you've been heavily investing in tech, like you've been too heavily invested in tech, and you look at the market now, your portfolio is performing a lot worse than if you're more diversified right now. But for the past 3 or 4 years, your portfolio has probably outperformed. It's not probably your portfolio has outperformed an equal weight index, but we see the RSP, once again, not stock recommendations, just the equal weighted index. We see that starting to outperform some of these cap weighted indexes that show the concentration to the tech sector, to the AI build out. So when I say equal weighted index, that just means whatever number of stocks are inside the index, if it mirrors the S&P 500, take the number, you divide it equally into the number of stocks, and that's equal weighted. Whereas when it's cap weighted, that's more of like how much the actual market capitalization is of the stock. So if the stock is like NVIDIA, NVIDIA was what, $4 or $5 trillion. So it was more of the market cap than say at the time. Just think about it, Intel, even though Intel's had a run now, but like when Intel was a much smaller market cap. So it didn't weigh as much inside of it. Whereas, so like the Mag 7, which isn't really even a thing anymore, while it was a big thing still going, it got up, even at the beginning of this year, it was like 35% of the total market cap weighted, right? So that's what it made up from the market, those 7 stocks. And the rest of the stocks in the market, the rest of the 493 made up 70% and divided however they were weighted. But the equal weight stock markets are, so you take those and then you just take how many stocks you have and divide it equally. So when you hear people talk about cap weight versus equal weight, that's just kind of what you're thinking. Right now, equal weighted stocks, the equal weight stock index is outperforming cap weight. We're seeing rotation, so a big circle, a secular rotation that we're seeing right now for the tech into like healthcare. We're seeing some of the beneficiaries of AI build right now. People want to see what's happening with AI. So we're seeing the beneficiaries continue to grow from this right now. We've seen healthcare grow. People are seeing innovations inside of that. Industrial, so as the build out continues to go, financials that finally come to life. Someone has to finance this building. We've seen the IPOs. I did live videos on SpaceX and IPOs. So if you want to check those out, check them out in the description. Just go to the channel and check them out. But we've seen a lot of those as well. And so one of the reasons the banks are earning a lot more, or you see them finally making it, like I said, with the AI build out, they finance these things, they give people debt. Once again, they're financing at whatever the Fed fund rate is, plus their spread, so they can make their money. Then even if it's coming from a corporate type of debt, so like junk bonds or spread, when people talk about spread is, let's say you have, let's use Oracle. Oracle's issuing debt. Oracle's a big name right now for people. Oracle's had terrible, terrible years since its highs. It's well off its highs. It's almost above $300 now. Oracle's barely $120, somewhere in that range, in like less than a year. But a big part of that is because of the debt and the way that Oracle is building out their facility, and people are worried about the Oracle debt build out. How is Oracle building that out, and what is the spread? What are people willing to pay on top of that? So let's say, and I think right now the 10-year bond was, last week got to like right around 4.7%. So the spread on top of that, let's say Oracle, and these are hypothetical numbers for Oracle, whatever their debt spread is, or any bond when you talk about the spread. So it will be the 4.7. Let's do easy math for me, a simple man like me. Let's say 4.5 for the 10-year treasury. And then let's say you're getting a corporate bond. And the reason you need more money is because it has more risk, right? So the United States has never defaulted on its bonds yet, or any of its debt. Knock on wood, has yet to default. We've yet to not pay back anything. So you get the full faith and guarantee of the United States when you, whatever that means, whenever you invest in a paper like U.S. paper, treasuries, anything like under 10 years, right? So when you're investing inside those, but even if you're investing in something lower, yeah, it's just not called paper. But you get the faith of the U.S. government, so that should in turn require a lower rate than if you were investing in a company that may go out of business or may have a higher risk of not being able to pay you back. Obviously, then the U.S. government is going to have a higher risk of not paying you back. Any corporation in general would, because USA, especially the way it's set up now, like the government's set up like a big corporation. But when you have those type of things in that setup, so the spread should be how much risk you're taking, right? How much extra do you think you should get? How much juice you should get for the squeeze per se, right? Do you think Oracle's extremely risky? Should you get 2 or 3% on top of it? Once again, numbers that we're talking about arbitrary. This is more for a purpose of just speaking and educating. Yeah, it's been a while, folks, since I sat down and just gone on tangents and spoke the main street. So yeah, I just really appreciate everyone who listens, everyone who's joined, everyone who subscribed to the Main Street Meets Wall Street podcast. Like I said, this thing is global. It's like 20 some odd countries that have listened to this, maybe even more. I should pull up and show the analytics. And what's cool about it is like only half of it is United States. So it's really like going around all around the world. People are listening to it, checking out the podcast and the show. So we really do appreciate that. The Wall Street South Journals, it's over 1,400 subscribers right now. That's a monthly newscast, monthly newsletter that we put out over there from ABC Squared, straight out through my LinkedIn page, Marcus Sturdivant Sr. So we put that out. And then, like I said, this channel is just growing. So thanks for watching, everyone. I do really appreciate it. Subscribe, all those great things. But there's still so much more to go. And it's just been a while since I've taken the time to just sit back. Thank everyone taking time to just reset the channel. People wonder what we do, who we do it for. Do it for y'all. Do it for Main Street. People are talking about what is this about? Why are you doing this? If you want to go back and listen at the very beginning, some of the early episodes, we talk about that. Why we're doing this. Just want to help educate people who, I don't want to say they don't understand or they just don't understand. There's conversations that we don't have, conversations that we didn't have growing up at the dinner table. That's why I sit here at the dining room table sometimes and have these conversations with y'all. If you come into my home, we can sit here and talk about these things, and just figure out what Main Street needs. That's how part of this episode is going to come up. We're going to go to the back part and we talk about the history of 401ks. This was actually someone who reached out and said, hey, so something you should elaborate on this. I think more Main Street wants to hear, and I was like, I got a whole lot of hours people could find it, but no. Main Street asks, I'm going to give it to you. So at the end, we're going to talk about 401ks and like the history of them, how they weren't there before 1978. So that'll be a cool conversation. Or I guess it's a monologue. All right. So Apple, I want to dive into Apple actually. We want to talk about, before we dive into Apple, with these geopolitical conflicts going on right now, with the midterms happening right now, we have the House of Representatives going on recess. The Senate, we'll see whether they go into recess or not. Some people are pushing for them not to go into recess. We'll see. But when you have these type of things going on, you're going to continue to see the stock market be extremely volatile and choppy. I think we'll see some more clarity once we reach the midterms and toward the end of the year. But even in the last month, we've seen the volatility of the VIX index raise, several percentage points, so not just like little basis points, like big whole percentage points. So we'll see some more volatility as, we're literally in a war right now. So when you're in a war, you can see different type of volatility. We saw Ukraine possibly getting involved. So it's expanding outside the region. They're saying that Russia's helping Iran with satellite imagery. There's just a lot going on. Hopefully this conflict is over sooner than later. We've been going since February, so here we are, February to July, we're 5-6 months in. February to July, that's 5, 2 to 7, that's 5 months. So we're a little over 5 months in right now. So hopefully this conflict can come to some resolution. Apple, why does that say Apple victory lap? Call back in January. It's very funny, man. The mainstream and the fancy folks, they see these things, they call them and you hear it. All you're hearing about right now on the news or wherever, if you listen to economic news, how Apple's the winner, Apple's this, Apple's that. And Apple does have a nice runway right now to be the winner. They don't particularly have anything to impede them. I think the next big challenge they may have is in September when Tim Cook steps down and the new guy steps in, right? But it's all over financial media, financial literacy, or financial media, financial news. Apple's going to be the winner because Apple's native to most people. Afterward has iPhones, the built-in system. When's the last time we haven't paid our subscription fee? But why I giggle, or I didn't giggle, grown men don't giggle, I guess, but why I chuckled a little bit at the beginning when I said this is because this Apple conversation that's going around right now, we literally had this conversation on 3 Pro K TV in January with live audience in Vietnam, like I said. So the question was, and the question they asked me was Apple or Google, right? And once again, I don't think, especially if you're a long-term investor, like you're not going wrong with either of them. But, they made me pick one. So I picked Apple. And this was at a time when Apple was way down. Like I said, it was January. Apple was down. Apple and Google had just announced a partnership. And that partnership, actually, Apple is paying Google. So it's like, people are like, but why are you saying Apple? And I'm like, Apple, and I'm sorry, folks, let me make sure you all realize this is not a recommendation. For any stock, everyone's individual investments are different. Everyone needs to approach them individually, So this isn't an individual stock recommendation for anyone. This is just the case I made for Apple, and just want to elaborate that this has happened before, right? And I shouldn't say victory, right? Maybe it should say humble brag, or maybe it should just say the fact that Main Street has a lot of information that, we're giving it to you from here, right here. This is an outlet for you all. You need to share this with people. You need to let people know, come check it out, man. No biases, no political fronts here. If we're going to bring something to you, we're going to give you both sides of the story, you know what I mean? And hopefully you can make an informed decision yourself. Like I was saying in January, so Apple, I said, you have the whole built-in system with Apple, you have the services. Because I was thinking, like, when's the last time I haven't paid my Apple services fee, So you have these things coming in, they're just built in, people are going to get them. And Apple keeps messing up, Apple keeps not quite getting it right with the AI build out, and part of the reason everyone was saying, Apple is not spending any money on AI, on their AI build out. And I'm like, and I don't want to sit here and make it sound like I was the first person to say this, but I was one of the earliest people to say this, I feel like, and you can go back and even look, like, when I did stuff with Samuel Brink from Business Society, I think I told him, like, Apple's a stock you want to pretty much just hold, But I said, so Apple has the native environment, and it always comes back to Apple. Apple doesn't have to be the first one, right? So the early bird gets the worm, but the second mouse gets the cheese. Apple gets the cheese, right? You know what I mean? Like, Apple they don't even have to be second. Apple be third, fourth, but generally and usually once they've taken that time, Apple's going to do it right. So, like, Apple will have the best version of it. And then if it's not correct, they'll figure it out. Now, they have definitely struggled with devices here. Some of the things Apple has done, the software, the music, Apple is innovators. It'll be interesting to see what can happen. Apple's been going up in this market when everything else in the tech world's been going out. Once again, Apple took a lot less with the CapEx. So they have more money that they can spend in CapEx right now, but we'll see if they do. We'll see what they say. Apple reports soon. So Apple, just part of this mega cap earnings season that we're in right now. Earnings season's actually gotten up to a good start too, but it's projected to be a very strong earnings season. So it'll be interesting to see what Apple has to say. This is getting close to Tim Cook's last earnings call. I think we'll see. Yeah, this might be Tim Cook's actual last earnings call. Yeah, I guess this is his last earnings call if the new guy takes over in September. Yeah, he might be on the September call. But anywho, so Apple, like I said, Apple's native. If you worry or you're wondering, just think about last time you didn't do whatever you did with Apple. I know half the world doesn't have Apple, and a lot of people don't like Apple stuff. But Apple's ingrained in a lot of things, and Apple's actually now making moves with their AI. Once again, not stock recommendation, just conversation, just something that happened back in January, And now people are talking about it in July or in June, and just, Apple, right? Another thing that we're talking about, way back when, once again, these are not stock recommendations, but Intel. Intel was a stock that I was talking with Samuel Brink about. So when I was talking about, people want to know, like, my opinion on stocks. You can find it. It's printed in the media, right? It's like, so those are and those aren't recommendations, but those have more of a thesis behind them that I've written out or elaborated in there than I really am going to go in with these videos, because I could go for a long time on each one of these. But the Intel was at $20 at the time. We've seen Intel rise to like up over 120. It's back hovering around $100. One of the things at the time was the government was bent on making Intel America's chip manufacturer, right? As part of the AI build out, Intel was integral to it. And then we saw, so even in the Biden administration with the CHIP Act, we saw a commitment to building chips in America, foundries, we want to build foundries. Intel just seemed to keep messing up, tripping over their own feet. Intel finally switched out CEOs. They got a new CEO in there. They started the turnaround project, and also the government took a 10% stake in Intel. But that 10% stake was, like I said, at like the $20 level, and Intel stock has since soared up way over $100. Intel just had their earnings call last week. Intel reported pretty strong quarter as well, and they like their projections and their forward-moving guidance for Intel. So Intel is another one that we were talking about a long time ago, but people have been speaking about here recently, like once it jumped to, because when it jumped up to 100, it jumped. Like it made moves, jumped in tranches, but when it jumped, it went way up and real high, parabolic to word for. So interesting to see that with Intel. But Intel, Apple, I think Microsoft's an interesting company right now. They have a lot of leverage to pull. I don't think they've pulled. We're starting to see those turn around. A lot of the cybersecurity companies definitely should be coming in to play right now. But this market has brought it out. And while people may think that's worrisome, it's actually a good sign for the market. If you don't want an AI bubble, if you don't want a bubble to bust, you can't just keep letting concentration get so high. So high, so high, so high. And where people worry about signs that we're looking for, or what people are looking for with the AI bubble, how is this being serviced? How is it impacting free cash flow from the corporations who are using this capital expenditure? Like, where are they taking away their money that they have after their sales to fund this? Like I said, the free cash flow, or are they going out and using debt to get it? Which, once again, issuing out and paying people back money, so that's some of their cash flow as well. Or are they even issuing equity? I think part of the call last week was part of the problem with Google, because Google stock went down, was they said they were issuing more equity at the market rate. So that was then to fund their AI build out. So that was an issue. We saw Google really crash last week, like just stumble and go down. So yeah, Intel, like I said, 20 to 100, it's just corporate realignment. What we're seeing right now with like Apple, Intel, all these tech stocks, I think right now is a re-rating of these stocks. The whole sector actually, especially like inside the semiconductors. So what we're saying is you see those re-rate, you see them move lower, multiples, all those things are readjusted, that to where their actual earnings are. It actually makes some of these stocks cheaper when you look at them, like the price tag may be higher, price tag may be lower. Sometimes it makes them higher too. But yeah, it gets back, this re-rating and this market adjustment right now is definitely, whether you can feel it right now as healthy or not, is healthy, right? One more thing to think about with the Intel, right? So if you bought Intel down here at the $20, or Intel was like $12 not long before that, and you had a bunch of it because it was so quote unquote cheap. When I say cheap, that's really not what makes it cheap. Like even right now, Intel's price at $100 some odd dollars, it's not cheap because their earnings aren't, they're, I think before this last report, they were like 100 times. So it's like $1 per share was 100 times the earnings. It was crazy. It was bad. But that numbers probably came down now since the last earnings call. But what was saying, so like cheap, but if you had this stock at $20 and it went all the way up to $100, it's probably prudent to, I'm not saying sell it all, but probably trim some positions, especially if you had over like a year. So now you're looking at long-term capital gains with short-term capital gains. So if you had Intel that long for like over a year, it's probably prudent to look at Intel and trimming some of it, taking some gains, because you never take a loss locking in gains. Let's get that one more time. You never take a loss locking in gains. So anytime you have a profit, a stock or whatever, you're never taking a loss if you're locking in those gains, right? And you only take a loss when you sell, if it's down, right? Otherwise, these are all just paper losses. Another thing with the Intel thing is like, is this in a taxable account? Or are you paying taxes on it like now, or is it in a non-taxable account, like a pre-tax account of some sort, which make a difference with how much you trim or how you adjust your Intel allocations as well. Because like I said, with capital gains, short-term versus long-term holdings, if it's in a taxable account. And then with Intel, with that type of gain, I think a lot of people learned about that with the meme stock move that we had, GameStop, and then with Bitcoin and crypto, just how much it moved and people were selling them so quick, and they didn't realize that they were about to pay, whatever you may pay in taxes, 40% at the end of the day, state, local, federal. Once you pay out all your taxes, you just never know what may come out to when people aren't accounting for that when they're getting that money on the front side. So if you're trimming, just make sure you know that you're, while you're trimming, have a reasonable position. You don't want any of this stuff oversized. I think that's what we literally just saw right now or here recently, is that when you oversize your market or you oversize positions, it can make big gains, but it can also hit you with big losses and swings back to the other side. So we're seeing these things happening right now. Another thing, you don't have to chase these stocks, right? You don't have to chase some of these stocks at all-time highs. Sometimes it's good to buy a stock at all-time high because it might still be going up. But like Intel right now, like I said, it was $120 just a few weeks ago. Now it's down in the 90s to $100 range. like I said, these things are re-rated and trying to figure out where their floor is, where their footing is. It's probably not $20 again, but maybe it's not $120 again. So somewhere in between that range, you can figure out where it is. You don't have to buy it at the top end of that range. Same thing with Apple. Apple just hit all-time highs, but Apple, I mean, if you're buying these stocks to hold, like investments, like long-term holdings, you never know. Once again, not recommendations, just, these are what we have. This is what the world's looking at right now in this more economy. So, just some of those other ones. Then we saw, I guess I would be remiss not to talk about SpaceX just a little bit. SpaceX, and they had that IPO came out, the stocks lost a lot of value since then, or the stock prices come down a lot since then. They report next month, and then they have an actual place where they can, some of these options, some of the lockups come out. So we can see a lot more volatility in these stocks in between now and then. If the SpaceX in between now and then, it could go lower. It's trading, I think it was like under 120 today. I mean, could it go under 100? Could it go to 80? Like 80 is like half of where it came out at the IPO price. The IPO was like 135, but the first trade was like 160. So that's why I considered it. But could it go to that number? Yeah, absolutely it could. You have to look at these companies and stuff like that. So as I said before, if you're investing in a company like SpaceX, you have to know the volatility that's inside there, right? You have to know this company go way up or go way down. And then it's somewhat tied to Tesla. That was part of the thesis when people were buying it to begin. SpaceX going by Tesla real quick. And what actually happened is like in that first like day or a couple days, they got enough market cap gain and they did actually buy another company. SpaceX did actually acquire another company on all cash, pretty much the amount that went up in the stock. So they made acquisition, but they don't have enough market cap value to buy Tesla right now. They don't have enough quote unquote money to actually buy Tesla. Maybe they're going to do some of the GameStop stuff, GameStop, eBay, half cash, half stock, and then just look at you, let you figure it out. But once again, Ryan Cohen may be playing chess over there at GameStop. I digress. I lose and go back. But once again, that's just kind of where we're at right now. We talked about the Fed, Kevin Warsh coming up. We got the economic data. We just got back behind. We have to see if the Fed is going to look more at the inflation side or the employment side. What's going to push the chairman one way or the other? Actually, a board. There are so many other people on that board that one person can't determine what it's going to be, what the rate is. So you have multiple people on there for a reason. So you can get a quote unquote balanced outlook and representation for the whole country, because these governors are all from over the country. So hopefully they're out there listening to the people, and following data is needed, but Kevin Warsh is a new chair and he's going to approach things in different ways. So we'll see what you do, Chairman Warsh. But it's meetings next week. Then, like we say, we have Iran and energy impacting inflation, right? So it can make it higher. When it came back down, we saw inflationary pressures that were lower. Even when you strip out the core, we still saw inflation that was higher. And then we saw inflation that was dramatically low. So inflation is all over the place. They haven't quite figured out where it's at, what we're going to do with this inflation, probably holding steady. Talked about Apple, the Apple victory lap. I don't want to say victory lap, just Apple home back. It was more to let people know, like, and this isn't even just like for me, it's like people in general, you have to, there's great information out there and it's not all coming from mainstream media, right? Some of that stuff is slanted, tilted, and some of them have different objectives than to just bring pure mainstream information, right? So that's why I like to sit back and talk about markets. I can talk about those all day long, markets and this and that. But we're going to do a little bit of the, educational stuff that I like to do as well. So we'll talk a little bit about the 401ks, as I promised, so the man been how this is Americans, right? Like I said, they're not coming to save us. The government's not coming to save us, right? If you think the government's coming to save you, come on. We're tripping. Come on. So let's set the stage, right? Like I said, someone asked me this about the 401k and just talking about that. They saw something that was very interesting. And it is interesting, if you've never went through the history and thought and realized how we come about this level of retirement, why we have 401ks now when we had pensions before. One of the things so let's anchor this all to think about this. Anytime the government eventually offers some type of entitlement or incentive, so 401ks are tax advantage accounts, right? They can provide tax advantages for your employer and they can provide tax advantages for you. Government only gives you tax advantages or tax benefits. So things, usually if there's some type of long-term benefit for the government. Government sees the long-term benefit if they give you these tax benefits and tax breaks. Obviously, you're going to pay the taxes one day on your pre-tax retirement. So that's just a loan to them. Once you retire and have to pay those taxes. Uncle Sam loves it when people retire and they haven't done any Roth conversions or planning any type of tax planning or make their portfolio proficient, because they're giving him a great big check, because people don't even usually think about it. They just take out that money and they don't even think about what it is. But it shifts the risk. It's basically what it's doing, right? So it's just basically shifting the risk. And anytime, like I said, anytime the government is offering the tax benefits because they feel like they're taking some kind of risk off of themselves and giving it to whoever else it is, right? So before, and even before 401ks, like you have to realize there wasn't retirement plans, right? People grew up when there weren't a lot of books printed, a lot of things in the world, people and quality of life. So people's quality of life, life expectancy, like even into like, the last century, people did not have high life expectancy. I think it was like 47, 50 years old that people were expected to live. So you would pretty much work until you died. And then if you worked until you died or you didn't work until you died, you work until you were old and decrepit, and then people would have to take care of you. I guess it would be, your family or whoever is taking care of you at that point, or maybe the community, but you didn't have like a retirement account or 401ks. Some companies eventually you have to go to what was like a literal poorhouse, right? So you would have to go to a literal poorhouse at this point, right? That's what they had. So like I said, before that 401k plans became things, people faced going into like literal poorhouses. Then they developed pensions. But what you got with the pensions were sometimes you would get the pensions where the people would sell a pension, pay them, and then pay into them. And then the company may not even pay the pension. The company may go out of business. The company may only be able to pay pennies on the dollar to the pension recipients once they reach a certain age. So let's go all the way back. Like I said, so at the beginning, the burden was completely on you people, right? To retire, take care of their retirement. But there was really people didn't think about retirement. I don't even know how big a word retirement was. A lot of people read the Bible like growing up back then, especially because there weren't so many books in print, and there's nothing mentioned about retirement in there. Some people just didn't think about retirement. People just worked until they died. Lifestyle changes, industrial revolution, these type of things made it where people were living longer. Medicine and technological advances made where people were living longer, like I said, and then the industrial revolution moved people from. But these people were living out on farms, right? Agriculture, producing all these things with large families that stayed mainly because they had to work. Like these families had to have, 8, 10 kids because these 8 or 10 kids had to work in the farm. You know what I'm saying? These are 7 days on when you work at a farm. You don't get to take off days like pigs or whatever you have on your farm they don't understand holidays or national, federal holidays or anything like that. So back then, like I said, the full scope of it was on individuals to retire. You have to take care of it, right? Then eventually the government and people realize like this is crazy that people working, people can't retire, people are living longer now. They have nothing set up for them. We got Social Security set up. Roosevelt? Roosevelt myself, Social Security. So back in the 40s when we started this, that's when it really all kind of expanded. These type of plans, but you had Social Security, you had pensions before that, but Social Security was a system where we all think about now today, where you pay into Social Security, but it was much different back then. It was the same basis, but it was much more limited to people. I think you got like $20, $25 a month if you were getting Social Security when it first came out. Social Security was also a system that was set up from the beginning where like some of the first people who received money from Social Security had not paid enough money into Social Security to start receiving money back really for the rate they were getting. So Social Security kind of started, down from downtrodden, maybe as you want to say, starting at deficit, kind of is how Social Security began. But Social Security, so you have that built in to kind of help people, but that also didn't have like, health care for people once they retire. You didn't have Medicare, Medicaid, all that stuff built into that. Those came in separate acts later on, somewhere around when the 401k came. Anyway, so we go from the people funding their own retirement. Then you have pensions for certain companies when people reach certain ages and they've worked a certain amount of years and they've paid into the company. Company would say, okay, we're going to annuitize this to you for the rest of your life or however long you live. Pensions, back to the simple, like I said, we have the people who are agricultural out there and then people would end up in the poorhouse, like a literal poorhouse is where you would end up if you didn't have anything set up for you to retire. You go there. 1900, I think it said 47 years old is life expectancy. So people on the farms, growing up in the farms and literal poorhouses, right? There's just public institutions ran by the local government. It's just absolutely and utterly, we don't think about these things, when we're growing. Here the term poorhouse, but these things come from somewhere else. Like I said, in like the late 1800s, American Express was one of the first people who created like a corporate private pension. And then over the next few decades, other companies followed. So U.S. Steel, AT&T, Goodyear, these companies followed. Then the Great Depression hit, stock market crash, 9,000 banks failed. And that's when you start to see some of the deficiencies right there. And you saw Americans didn't have anything set up, right, for retirement and funding. So that's when they came up, Social Security Act, which was, supposed to be a three-legged stool initially how it came out. Social Security is going to be one, so that's the government part. employee pensions, that was going to be a corporate part, and then personal savings. People were saving, right? So they're individuals. So you got three legs to your stool, and that should set you up where you can retire. That was the thing. But like I said, we had companies where they were just not doing it. Some did, some people were doing ceremonies, giving out gold watches. And then we had a company like Sturdivant, which was bleeding money, and they just was taking the pension fund. It was underfunded, and then they eventually just didn't pay their people. Some of them actually got it because they got new talent before this company didn't get to a level where they could pay it. But most of them either got nothing or they just got like penny on the dollar. So that's just terrible, Then 1978. So 1978. So all this is before 1978. There's no 401k. They create a code, 401k, a tax code. And it's actually section 40. It's actually 401, like section K in this code. That's why it's a 401k. The government people are just, just say it how it is. But that's the tax code in 1978. And this was for compensating executives at the time, right? So this was for compensating like executives. People didn't even realize that these were for like employees, But once again, all this is about where the risk is being shifted. We're shifting the risk back to the workers, or we're shifting the risk back to the employees, right? Let me take another step back with this. So a defined benefit plan, right? And deferred benefit plan, right? So one, here you have the defined benefit, pay into it, you're going to get this at the end of the day. That's more of the corporation taking the brunt of it, the burden. And that's what they did not want to do, They wanted to make it where you pay into your own plan, and if you retire, it's more in your hands, Anyway, so the 401k was originally created for executives, but then they saw like a loophole in there, and they realized that the 401k was actually set up where you could use it for any employee. And there was a gentleman who decided he was going to do that, and he took it to a client, and the client didn't want to do it. So he actually started with his own business first. I think in like the early 80s, because there was just a little section there that said that you could defer the plan back to the employees. So once they realized that part was in there, like I say, he realized that you could do that, and the company started doing it. Ted Vienna. So pretty much created that once he realized that and started doing it for his own company. So you had the 401k, then they kind of not codified it, but they went in and kind of gave it more regulations and guidelines in 1982. So as we see this increase into the 401k, we see pensions start to fade away, right? It's rare that you find someone with a pension nowadays, especially like someone younger, jobs that offer pensions. There are still some out there, but it's just a rare thing that you see right now, right? So then you see people going to a 401k. What are some of the benefits of 401ks, right? 401ks, so like we said, some of these are, depending on what your tax as is, pre-tax, they can help with your tax bill, but it's just deferred tax. The employee match is a big part of it, right? So if your employer is matching you, that's essentially quote unquote free money, whether it's vested or not. Hopefully it's vested. Hopefully the match is vested. I think I saw a post out there where someone said the match vested in staunches. And I've seen that before in employee plans where your match vests like over a year, 2 years, like 4 years, you got the full match, all that stuff's back in there. But if you leave before that, you don't get that. And that was one of the big things with the 401ks too, 401k plans as well. Like a lot of these type of flexibility, depending on the plan, depending on who it's set up for. So just a lot of it's interesting that this 401k plan was set up pretty much, like I said, by accident. And then the gentleman realized that there was a loophole in there where you can actually make it more beneficial. And then, of course, Wall Street took advantage of it. Well, I won't say took advantage of Wall Street. Definitely went there and checked it out. Wall Street went in there and built funds, mutual funds, and index funds put inside of 401ks that they can sell to people. Once again, like I said, it's really just, and it goes back to the risk transfer, right? So Wall Street didn't just create 401ks, engineered the greatest risk transfer in American history, one of them, right? But before 78, employers, they burned the button, guaranteed pensions, steady payouts, when they met these things, corporate responsibility. But after that single tax code accident loophole, that burden shifted, entirely on us, right? And now we have like 60 million Americans in their retirement, that they can't control. Fees you don't see and outcomes nobody can promise, right? Because even if you put all the money you were supposed to into a 401k, it comes out like what, 23.5, 24.5 a year if you're under a certain age. If you're not at the catch-up age, when it goes up to right around $30,500 a year, right? But if you start late, or that might not be enough, so you have to find other avenues and ways to save that three-legged stool. Don't count on Social Security now. That's not to say like Social Security being solvent, but if you can plan your retirement without Social Security and you have like the means to do it, that would be It's really a plus if you can do it without the Social Security. Like I said, yeah, so they just moved the risk back to the people, right? So it went from the risk that was completely on them to completely on us, right? So, like I said, nearly half of Americans 55 and over have no retirement savings. Yeah, I sat back on that one for a minute. So let's think about that. Half of Americans 55 and over have no retirement savings. People think that Social Security is going to save them. Social Security is not meant to fund your full retirement. It's a supplement to your retirement. If anything, it actually was built as a supplement to your retirement, right? We just saw the three-legged stool that we talked about earlier, but it's collapsed and now it's just like a single leg for people who and one-legged stools don't work, you know? That's a pogo stick with a seat on the top. That ain't gonna work well for you. It's not gonna work. So if you do have some type of 401k or some type of employee match plan, make sure you're getting it all the way up to the 100% of that match if you can, right? Never leave that on the table. Never leave that on the table. Check the fees that you're paying aside that. So many people, and this was a LinkedIn poll actually did, so many people don't realize that they're paying fees inside their 401k. They think their 401ks have zero fees. They're not paying anyone to manage it, you know, and even if you're not paying someone to manage it, your company's paying someone to manage it. Like, it may be a small fee, but it's a small fee. Check inside the actual funds that are in there. Most 401ks plans now are like mutual funds. So if you look inside there, make sure the expense ratio is not too high because they're definitely low cost ETFs, you know, 0.03%, 0.06%, you know, for these basis points. And then you see some of these other funds are, you know, 0.5%, 0.75% expense ratio. That's too high. See if you can find something lower than that for your expense ratio for the investment of the actual fund that you're in there. You can't rely on a single account, right? So mainstream, I'm trying to give us all some actionable steps. We can't rely on one single account, and it can all be like pre-tax or after-tax money. You know, we can't rely on one single account. I keep saying this: the three-legged stool is a real thing, right? How many legs you gonna have on a stool, right? So some type of the way it was set up, you know, and everyone has different variations on this now, you know, but you want to have multiple income streams, especially in retirement. Especially once you stop working and like earning income, you have ways to grow income. I think it was John Hope Brian, he said, you work in the day to earn your living and then your money works at night to grow your wealth. And I'm paraphrasing and butchering that all at the same time. But it's the intent that you work and grow and then your investments work for you, right? You let your money work. We hate lazy dollars that are not doing things for people here. So different kind of accounts help with the tax. They help with the growth. Peter Thiel, he's going to be a Roth billionaire, I believe. He started his Roth conversions like right when it became a thing inside his IRA, investment retirement account. And they were so cheap, like the stock that he had bought, and now it's appreciated so much. And he's going to be at the age where he can access this without a penalty or without a fee. I think it's come up to like $1 billion. Like, so a Roth billionaire, so tax-free withdrawals on that type of money is absolutely nuts and ridiculous, you know. But yeah, and that's the technical term, nuts and ridiculous, right? But so and then you need to track your household budget. Make sure that we're looking to see how much we have as our household budget. Check out My Not Money for that. For those anyone who is looking for a new budgeting tool, I have a link in the description for you. My Not Money's one I use an affiliate link. So if you do decide to use My Not Money, I may be compensated at no cost to you, no extra cost to you. But they have a free trial going on, so you should check it out. Link will be in the description. Same thing if you want to check out some of this market news. I know we're going back when we were talking about things earlier, but Benzinga Pro, I've got affiliate link with Benzinga Pro. Some great stuff with Benzinga out there. So we just talk about how Benzinga's on top of it, you know. So go in there and check that out. They have a link where you can start using them as well. So Benzinga and Monarch Money are some cool people helping Main Street folks. They're helping us down here on Main Street, you know, to grow into Wall Street. So it's good stuff. So like I was saying, so the risk has been shifted, right? So now here we are with 401ks, pretty much pensions are gone. And that has gone back into the portion where the risk has been shifted all the way back to us. You know, the risk has been shifted back to working Americans and completely away from the government or the actual corporation to make sure that people, you know, who work there for 1,000 years are actually compensated and taken care of. Now, once again, I want you to understand, you know, the collapse of the traditional pension plan ruined retirement for millions of Americans. And you got to understand, like, the institutional difference between a defined benefit plan, defined contribution plan. So when I talk about the risk shift, right? So I said that briefly earlier, defined benefit plan, that's that promised outcome, right? So you put money in here, right? You continue to put money in this pension, fine benefit is up there. Your employer say you work 30 years for us. Based on your final salary, we promise to pay you, I don't know, let's say $5,000 every single month until the day you die. Company has to hire, Wall Street managers, whoever invests capital, make sure they make that money is there for you. If stock market crashes and the corporation has the problem, right? Not you. Defined benefit. As long as you do what you say on that part, as long as you put it in there, they're going to give you that benefit. That is defined, right? So the defined benefit for it. But the shift now is defined contribution. So it's a promised input. Like in the 401k, the only thing defined is the contribution, right? Like there's no guaranteed result if you go in there and make bad investments or if you don't know what you're doing, right? Your employer can say to you, this is what you should put in there. Maybe it's 5%, 10%, 20, whatever they tell you, and we'll match whatever. But some people won't even match your whole percent. So yeah, you may have to put in like 6% to get a 3% match, or 5% to get 3%, or whatever you have to put in there to get that full match, right? And then it's like, good luck. You know what I'm saying? Figure it out. I'm like, what? Okay, interesting, so it's not the same. So there you go. You're defining your contribution as long as you're contributing it to the, then but there's no benefit that's defined at the end. So you don't know what you're going to get at the end. Hopefully you invest in it wisely, and it grows, which, stock market and investing, usually over time, proper investing will grow. But like I said, Wall Street rebellion shift, as freedom and personal control, but once again, what it really did was it really took that personal corporate liability and just put it right back on people, right? Took the burden off from market volatility, inflation, bad investment picks, off corporate balance sheets and dumped it squarely back into Main Street, right? Back into our lap. So that's why Main Street, we need to be invested. That's why when you invest inside of your 401ks or whatever your retirement account is, you need to leave that money invested in there as long as possible. Don't go ahead and take that money out. That money's for later in life, right? So if you're investing inside those accounts, your retirement accounts, your 401k accounts, or your IRA, whatever kind of 403b, 457b, there's so many different accounts. Now you have the Trump Kid accounts where you can invest for your children. Got a couple good videos on those already up on the channel. Check those out. Be sure to check those out. But if you have those, right, that is just, you want to contribute to them to the level that you can. You want to contribute to a level that makes sense economically as well. 401k. So some of the questions people ask about 401ks, right? So should I roll over my old 401k from a previous job into an IRA, or should I leave where it's at? What can I do with old 401k? That's a question. What you can do with old 401k. So, and generally there are just kind of usually three things you can do with it, right? So you can leave it at the old place where it's at. Just leave it there. Unless sometimes they make you move it if there's not a certain amount in there, if you've left it there too long. You can roll it straight. You can roll it directly into your new employer. If your new employer has a 401k or retirement investment accounts benefit plan for you, you can roll it straight into there. And if you do it, if it's a pre-tax account, you do a pre-tax or pre-tax, there will be no tax. Implication will be no tax penalty or anything inside there. So you can roll it over, or you can take and roll it straight into an IRA, individual retirement account. So you can do that. And once again, if it's still the same tax status, you're not going to pay taxes on that at all. So long as you keep a pre-tax or pre-tax, or if it's after tax to after tax, you don't want to go after tax to pre-tax, but you'd be surprised what people do sometimes. Tax status is important, right? And so you want to make sure if you're moving it, you're going to move it to the same tax status as it was before. Unless you're planning, maybe you're a young person, maybe you're Peter Thiel, and you're in your early years of working, and you've been at a job, and you earned the least amount of money you've earned, and maybe now it's the time to convert that money over to Roth. Or you're working and you've got laid off, and it's going to be like your lowest income year that you would have in a while. Maybe that'll be a time to go and take a 401k and roll it over to Roth. Once again, not investment advice, because everyone's individual experience is different. Everyone's individual goals are different. So you just can't make blanket recommendations. Watch out for people who just make blanket recommendations. People are just telling you, you just do this, you do that. They always leave out a couple steps, especially on the tax side. That's where you generally get people. So that's what you can do with that 401k. Roll it into either your new workplace benefit plan, to a different type of retirement account, hopefully with the same tax status, so you're not paying taxes in both those situations. Or you can just leave it there if the people let you leave it there. Why would you roll it into an IRA or to a different tax account or into a different workplace benefit account? Because you may have better investment options. Usually inside 401ks, that is definitely one thing that we see. There are limited options that you can invest in. Usually in 401ks, you have investment fees. They're higher fees because they're mutual funds. So what you have there also, like I said, so you may have, just look at it if you can get into an IRA or something once you move jobs that offers lower fees. And now another good thing that we have inside of 401ks, we have the option they have what's called a broker link. So inside 401k now you have the broker link where you can go in there and actually go inside and invest different individual positions inside the 401k. So it doesn't even have to be the high fee index funds that we're used to inside the 401ks. So those are some of the things that people can do with 401ks. So like I said, in most cases, and then the expense ratio, like what's too high. I think I kind of mentioned that earlier. You want to keep that thing, under 0.5%, definitely under 1%. You can find those things for like 300%, 3 basis points. So you can find some cheap stuff, right? As far as the go, but you make sure you're not paying more than 0.5%, 0.75% for a basic index as well. You know what I'm saying? Because they're not really doing any managing in that thing. So look for a low cost broad market. Probably it's going to be an ETF. That's going to give you the best benefit for that. You can check out, got some videos on ETFs, how those things work, and mutual funds. Because sometimes mutual funds do work, but mutual funds are, they're going to actually be taking your money out as well. But they're literally mutual funds. So those funds can't be taken out by some of the people who mutual use. Well, I guess it's their individual use, but they're coming from mutual funds. It can create a taxable event. ETFs don't quite have those. So ETFs versus mutual funds it's a good video to check out on the channel, on this page, right? So ETF versus mutual funds. Then people may say, how does inflation impact my target retirement number, right? Because everyone always thinks, just get $1 million. And I say everyone's retirement number that's really an individual thing, right? Because some people can live off X amount of dollars a year. Some people can't live off X amount of dollars a year, right? $1 million today buys you a lot less than $1 million bought you 20 years ago. In the case of probably be that $1 million today will buy you a lot less than $1 million will buy you 20 years from now. So you have to think about that when you're investing. Same thing goes for $1, $100, 500, whatever your dollars are. The purchasing power, we've seen purchasing power shrink dramatically here over the last few decades. So individual purchasing power, I should say. We've seen pricing power on the other side by the producers grow. So the ball's in their court. But inflation pretty much erodes purchasing power, like I said. So that $20 million is going to be the same. And then even if you want to keep it all in cash, and you're like, I'm keeping up with, not all in cash, you don't keep it all in cash, but let's say you keep it in cash always loses to inflation. Cash going to lose to inflation because even if it's sitting in like I say, a money market account or something that's a high yield savings account, something that earns interest, it's based on the Fed fund rate, and the bank's still making money. Banks always going to make money, right? It's no matter how much or how little, but banks are always going to make money. As long as they don't do anything like crazy and get over leveraged, banks should make money. But we see when they create crazy things and get over leverage, we see financial system crashes like 2008, housing market crash. That was just, that was a conflagration of things. And we saw it really led to a fireball, just terrible, terrible experience for our Main Street. That's what we saw. But yeah, so inflation really decreases purchasing power. So unless wages are keeping up, wage growth. So if that won't impact $1 million versus being $1 million, still $1 million. But that can help you at the saving rate where you can increase. So you just need to figure out what it is. A lot of people are like, $1 million, I'll be set. Maybe you will, maybe you won't. And some people may be set, $500,000, $200,000. You just never know. It's such an individual thing for everyone, for you, for yourself, how you want to go about it. So however you want to do it. So yeah, I think we've talked a lot. I'm trying to think if there's anything else about the 401ks or this market that we're seeing right now. I mean, there's a lot going on in the world. If you don't have a retirement account, you need to set something up of some sort. It's never too late to start. If you're over a certain age and you don't have a retirement account, maybe you should just go ahead and set it up as a Roth, right? Don't even worry about that pre-tax benefit. Go ahead and get that money in there now where you can get it tax-free later in life. Chances are if you don't have a retirement account set up already, you're probably not ready to retire. If you're a person of a retirement age, old enough to get the full benefit of the Roth. But you want to have these type of things set up in place. You want to have these things ready to go for the world. Just what's happening. Woo! Yeah, we've covered a lot of stuff here today. We sat here, we've had massive, just long conversations, a good conversation, but it's been a long conversation. It's been a while since I've just sat and vented and talked to you all Main Street. Like I said, Main Street, I really appreciate you all listening. You all are just, y'all fuel me, fuel to the fire. People out here, I mentioned the podcast and that is global. I mean, it's global, seriously, the amount of people who listen in different countries where they're listening from. It's really cool to see. It's really cool to see the growth. I love when people send me in questions. I love answering them when I can, like the 401k that I'm moving into. I could probably go even deeper into that, We're already a little over this one with the market cap. I could do a whole video just on 401ks. So y'all let me know on retirement accounts or why they were set up or why they're y'all let me know what you want to hear, Main Street. Let me know some of the questions you have. The podcast, like I said, the podcast is over 50 some odd episodes deep. So that is That's a beautiful thing, full of
So,
individuals and
guys,
great information. A lot
only
of
one person,
interviews. We
and
want
then
to cover
when
the
the
whole
other
spectrum with
person
the
comes to
podcast.
talk,
For those who don't know,
the
we're trying
half
to reach a lot of people.
I'm
I want people
surprised
to
all
see,
you
to
when
hear. I want to help
and then
financial literacy
shot
be spread out across
him
the world
and
for
then
people who don't
when
know
he
about it,
gets to
people
the
who've yet to
middle
see
of
it.
it,
I do actually want to take a
just
second here
feed
and
him.
I want to show you. So yeah, I want to show you, I tell you this is a global community and I really do appreciate everyone looking, everyone listening. I appreciate everyone who tunes in, so the last few minutes, I just want to take and I want to show you all. I want to thank everyone, for tuning in. And I just want to show you, look at where people are watching from. So 55% from the US, 10% Austria, thanks Vietnam, Brazil, Jordan, Indonesia, Pakistan, Ecuador, Iraq, Colombia, the Philippines, Norway, Bangladesh, Jamaica, Russia, Brunei, France, Algeria, Kenya, the UK, United Arab, Congo, India, South Africa, Mexico, Angola, Costa Rica, Venezuela, Argentina, and the Toga. So anyone, everywhere, all you people, hey, thank you. Appreciate you tuning in. Appreciate you watching. These are real numbers. These are the real things. Like you see them. Like it's very humbling. I really do appreciate it. Let me know what topics you all want to hear. Let me know what you want me to talk about, what you want me to expand on. We have some great stuff going on that we actually just did with Ashley Kwame, where we're talking about financial psychology. Got some great stuff coming up, some great guests coming on. Like I said, the Main Street Meets Wall Street podcast is over 50 some odd episodes. The YouTube channel right now has, oh my goodness, it has a couple hundred videos, maybe. I don't know. You're counting the shorts. It has a lot of videos. So there's a lot of information over there for folks who want to get the information. Like, it's there if you want to hear it, you want to see it. There's a lot of information. I hope you share this with people. I hope you subscribe. I hope you let me know what some of the questions you have, some of the things that are, impacting your world. And yeah, Main Street, I just don't really know how to thank you enough. I really appreciate it. We got some live sessions coming up. If you haven't hit the subscribe button, hit that like and subscribe button. Check out some of the links. Like I said, the Benzinga Pro, Monarch Money, subscribe to the Wall Street South Journal on LinkedIn. For those who don't know about the channel, the tempo of the channel, what we're doing. So every Tuesday night, you're pretty much going to get a podcast interview. I have a guest. It's good stuff. And we've covered so many things. Like, just go back and check out the podcast. I think we've covered pretty much encompassed the whole economy in some type of way. So if there's something we've missed, let me know so we can cover it in discussion. But we just finished up the Bitcoin discussion, right? Crypto discussion where we had the bears and the bulls. So that's on the channel if you want to listen to it. The debt discussion, like I said earlier, we're talking about the debt. There's a lot of stuff that we go back and talk about the history of just finances, Dow Jones, like to do history stuff. Then we have live sessions where we go live and talk about the market and what's happening right now, right there, where anyone can tune in and ask questions. That's a really good thing. We love going live over here. And yeah, check it out. We have a lot of stuff in print as well. People who are asking questions, journalists, so different places all around the world. We're recorded in media. You can find us on LinkedIn. You can find me on YouTube, Marcus Sturman Sr. Also, we have the Main Street Meets Wall Street podcast, which I'm talking about right now. I guess that's it, Main Street. I'm pumped, man. So excited. It's been too long since I've been here. Always check the fees before you do anything. If you're looking for someone you don't understand what they're offering you, probably say no till you can get them to explain it better. But one good question is to always ask someone so how do you get paid? That's a good question because they'll tell you a lot. But I got a video on that too, whether it's fee versus commission. That just tells you where it's setting up. But that's a good question. If you can figure out how a person gets paid, you may be able to figure out part of the way they get money. And if that person can't explain to you how they get paid, that's a big red flag right there. But once again, anyone listening, if you found any value in this conversation, hit the like button, share, subscribe. This is a good week. It's a beautiful day. Watch out for market turbulence. Once again, remember, it's only a loss if you sell. It's only a gain if you sell, right? Otherwise, it's just paper, losses, gains, and sales. Main Street, I really appreciate y'all. I've showed y'all the stats, right? Showed you that people are watching us globally. This is happening. Appreciate the support. Let us know if you need anything, Main Street. We'll be live soon. Check out the podcast episodes coming out. That tempo coming. And then, yeah. And then Saturdays or Sundays, somewhere over the weekend, we'll probably drop a video too every week. So you get a couple videos every week from this channel. Actually, been trying to pull back. I feel like I've been I've put out too much stuff too quick. So I don't want to inundate Main Street with it. But if you need more, let me know. Just tell me you want to hear some more stuff. We can get you some more stuff. But Main Street, Hart meets Wall Street Smarts. Hit the subscribe button, hit that like button. Tune in, check us out. Main Street, Hart meets Wall Street Smarts. They say I'll talk fast, but if you listen fast, I'll have to slow down so you can catch up. Curtis Jackson. Look at what's happening in these markets right now. Everyone on financial TV is giving you the exact same corporate canned answer about artificial intelligence, Fed rate cuts, and record stock indexes. But last week, I sat in a room packed full of institutional asset allocators down in ATL, managing billions of dollars. So I sat on the panel, I asked them two simple questions. One, how many of you use AI tools every single day? Nearly every hand went up. Then I said, no need to raise your hands for this one, but how many of you want a multi-gigawatt institutional data center built in your backyard or in your neighborhood? We just let them sit on that one. This instant contrast exposes the exact fault in the global markets today. Wall Street's pricing in infinite software promises, while Main Street's running directly in the hard physical limits. Power grids, land constraints, regional geopolitical shocks, and sticky inflation rates that refuse to die down. I'm Marcus Sturman Sr., founder of the ABC Squared and host of the Main Street Meets Wall Street podcast. We're going live right here, right now in Charlotte, North Carolina. The Wall Street is south. Got a little storm coming in. Let me know if you can hear us. Let us know where you're tuning in from. We're live. For those who don't know the numbers, Charlotte isn't just observing, global finance from the sideline. We control over $4 trillion in headquartered banking assets, standing firmly as the second largest money center in the United States behind New York. It's the primary headquarters for Bank of America and Truist and the nationwide operational engine for Wells Fargo, Vanguard, and Barron's. This city sits at the exact intersection where institutional capital flows data into real-world commerce. That's the mission of the Wall Street South Journal, right? We don't deliver speculative hype, and we don't repeat PR press releases. We bring Main Street real talk straight to Wall Street capital, giving business owners, executives, self-directed investors the unfiltered institutional mechanics required to build, preserve, and scale True's intergenerational wealth, something you can pass down. Now, why does this perspective matter to you? Because you've officially transitioned out of the era of easy money and predictable central bank forward guidance. When we look across the macroeconomic landscape right now, analyzing these markets is like stepping outside and asking whether it's partially cloudy or partially sunny. It depends entirely on where you stand. On one hand, you have massive capital expenditures driving mega cap tech. On the other hand, you have a bond market, which is the absolute big brother of financial assets, signaling that inflation isn't touching 2% anytime soon. And then we still have geopolitical conflicts threatening to push oil right back above $100 and right onto our doorstep as a consumer. If you're trying to navigate this environment using 2020 rules, you're going to get caught in that leverage trap. We saw the leverage trap as it was happening over in South Korea. Those markets and the concentration with the Kospi, and then we saw the leverage that actually was unwound and the way that stopped whole entire market right down. So we're going to sit here and we're pulling back the curtain on everything from Federal Reserve communication or lack thereof, the chaos. We're going to talk about some high-profile family estate lawsuits, semiconductors, free cash flow, the the circular tech movement, and how to build an unbreakable anchor into your personal portfolio. Once again, this isn't investment advice. This is just things you can take. Every situation is different, so you have to know your own personal investing situation. But it's just something we're doing right now, letting people know. We have the Wall Street South newsletter. We're going to share our most current edition, which also published as an article on X. If you're enjoying this, like I said, give us a shout. Give me a 1 if you can hear me, if the audio is good. And we'll jump right into it. So for those who don't know, this is Wall Street South Journal. This is an X version, but it's published on LinkedIn. A little over 1,400 subscribers right now. And so this is just this is a summation of a lot of things that's been happening, right? First of all, I was invited. Thank you to the Titan asset allocators for inviting me down to a special dinner and sit on a panel. And on the panel, like I said, one of the first questions they asked were about the data center. The next thing they asked about was AI in the data center. Then we got into the conversation of just where we're at in the world in general, right? So like I said, this is the Wall Street South Journal's July edition breakdown going into August. So it was like a weekly cadence with the newsletter, but now we've moved into a monthly cadence and gone to a much more denser deep dive look for those. So subscribe to the newsletter, subscribe to his YouTube channel, follow on X or anywhere that you can check out Main Street Meets Wall Street or myself, Marcus Sturdivant Sr. One thing that jumped out to me, we're talking about, we'll start right where it was. As I was driving down on Wednesday, I got to hear Kevin Warsh's speech in its entirety. So I felt I might be dating myself, but going back to like Green Day in that classic track, Basket Case, and it said, "Do you have time to listen to me whine about everything and nothing and all at once?" And I feel it's kind of like what Kevin Warsh did. He didn't really whine, right? But he just kind of went out there and he spoke, but he didn't really answer. He was kind of vapid in his responses, but maybe that's exactly what he was trying to do. I'm not quite sure. And the markets responded. The market went way down. Well, the market's already down that day, but once he delivered his speech, the markets went down even further. For those listening, I did air quotes. So another thing we have to realize is that Kevin Warsh has said that he wants to communicate different than Jerome Powell did. So perhaps this is how he's choosing to communicate with the markets by not communicating. He wants less Fed speak. He wants less noise, quote unquote, versus signal. He wants the market to tell the Fed versus how he felt before the market was reacting to the Fed. I kind of thought about like this, like Jerome Powell, just, even the way they approached the press conferences, because Jerome Powell was he would give me information in the press conference. But so, yeah, Jerome Powell's like a grandpa or someone sitting on that rocking chair right on the front porch of some like big old estate. He's watching it, right? Watching the whole global market. Everyone's running around, staying in their boundaries. Everyone kind of knows the boundaries of the yard. And then we have Kevin Warsh comes in, right? And Warsh comes in, he grabs the chair, and it's like Christmas or Thanksgiving. I got a really big family, extended family, like at the extended family's house where you got 1,000 people running around, and Warsh kind of just got into the recliner, lazy boy, laid back, and just made everybody run around him to see what happens. And that's not to say that Warsh isn't on top of it. I just think Warsh's style is different. We'll have to see. We'll have to give him the benefit of the doubt. But the bond market, like I said, those interest rates, they started to go up. During the speech, we saw interest rates, yields, I should say, not interest rate, but yields on the treasury bonds start to go up, indicating that the market thinks that rates will be higher and that there's only so long that Warsh will be able to, quote unquote, jawbone or just speak about what's happening in the market. At some point, he's going to have to do something. He's going to have to make a move in these actual markets. It's only going to be so long that he's allowed to just talk. So it's kind of like I said, the lazy boy recliner. And then after that, like the next couple of days, we had people coming in, other Fed chairs, and there's only one Fed chair, other Fed governors, vote members. We had 3 dissents on Wednesday. So it was a 9-3 vote, but the 3 dissenters came out yesterday on Friday, and they were all speaking and saying the reasons for why they dissented and stating what they see as the path forward. for inflation, and they definitely seemed like it was higher for longer. Another thing with the Kevin Warsh speech, it seemed to me kind of like when Ryan Cohn was speaking on CNBC, when he was just kind of like half stock, half cash. Like maybe he knows something we don't know. So we'll see. Like I said, but remember though, the bond market's huge. So whether the equity markets are going up or down, we can't really ignore the bond market, right? That's the big part. So a lot of people that bank on bonds, a lot of money invested in bonds globally. It's the big brother. Holds more weight and leverage than the equity market. Well, maybe not more leverage anyway, the way people continue to leverage things, but it's ridiculous. So those are some of the things we're talking about globally with the Fed and economics. Then in the newsletter, like I said, I want to encompass the total things we talk about money and family, prenups, estate battles, and money dates, right? These are some of the things that are in the news right now. We just saw, I just sat down with Ashley Kwame. She's a certified financial behavioral therapist. And we did an interview. It's available on YouTube. It's available on YouTube. The podcast is out on the Main Street Meets Wall Street podcast, wherever you get podcasts. It's out there. By the way, if you're finding any value in this video, hit subscribe, hit like, share this with people that you know. But we're talking about families, prenups, estate battles, money dates. And like I said, prenup's a dirty word, apparently, 4-letter word. But it's not. We can see right there it has more than 4 letters. But with the prenup, we were speaking about how it's not necessarily a terrible thing for someone to have a prenup. And then literally, as we were speaking about, we saw the Malcolm Jamal Warner prenup thing start to blow up, where his widow is suing his estate. So let's sit there for a second and talk about that for a second. His widow is suing his estate. And part of the reason his widow is suing his estate is because it was set up where Malcolm Jamal Warner was supposed to have $1 million in life insurance. And I think it was supposed to be reciprocal. So she would have a policy back in the same way in case she passed away. Anniversary payouts, like $15,000 to $20,000, somewhere in that range on their anniversary, they were going to pay it out, which, okay. And then there was an annual salary for the role she had in the company and managing, and then guaranteed accounts. So she wanted a retirement account that was fully tax-free, I guess some type of Roth account or something that she could have funded to a certain level, and then college for their children to be funded, which those things aren't outrageous, And I believe at the time, Malcolm Jamal Warner was reported earning about $600K a year between residuals and all those things. Still active. I mean, he was on the Cosby Show. He was on Malcolm and Eddie, and then he was even on other shows after that. So Malcolm Jamal Warner definitely could have some residuals coming in. Could have. Rest in peace to Malcolm Jamal Warner as well, too. But this situation, like I said, provides a critical lesson. Even when you have a prenup on paper, legal frictions, family obligations, disruptions, disputes, they can still explode. Just got to make sure it's legally tight, and we'll see where it plays out in courts. But none of this matters if they don't do it anyway. We haven't seen it happen. So we'll see how it goes. Like Ashley said, nothing brings out underlying hidden tensions like a good old-fashioned family fight over money. So Ashley, like I said, she was great when we sat down. We talked about on the podcast, emotional and psychological impact of money. How do couples view money? What do two people in the same household? How can they perceive money so differently? So if you want to check that out, like I said, we got a deep dive into that. But one of the concepts that she spoke on was a money date, which was very interesting to me. So it's where a couple, you and your significant other, she would suggest you do it in the daytime, probably in the lunchtime or somewhere where you just schedule into your work day. I guess it can be virtual. I don't guess she said it can be virtual. It can be virtual. It can be in person. Maybe you're going to get lunch together. And just sit down and talk about your finances. But this is after you've already had conversations to establish where you're at. You'll be surprised how many times you'll see a person who is two people who are married, been married for a long time, sit down and talk with them. Let's talk about your goals, what you want to do when you're retired, where you want to live, how you want to live. And when one spouse says, I want to live in the mountains, one spouse says, I want to live at the beach. Right? So there you go. And that starts the conversation. So before you get into the money date, you got to figure those type of things out. Too. I want to have your budget figured out, those type of things. Then you want to figure out where you're spending, right? But the money date is a good way to make sure that you're actually having some targeted conversations with your spouse or significant other about money, about the ways that you view money, how you're spending money for the month. You don't want to tell someone they're spending money wrong. Ashley, to go back to the conversation, she gave a great example of her husband now has taken up hunting, or maybe he's more of a hunter than he was before. We spend a little more time hunting right now. So, and that's the thing they discuss, with hunting. It's not people are like, just stop getting a cup of coffee out every day. I mean, that makes incremental savings, but that's not going to save you, quote unquote, as far as saving goes, money goes. There are other ways to go about it, but you need to figure out, like, if that cup of coffee is important to you, man, if it helps you every day, if it's got to be certain brands you get in there, it's like the middle part of it, maybe you should get your cup of coffee. Maybe you should have that experience every day and figure out another way to save money. But you got to figure out what's important to you when you're spending money, because everyone spends money on something. We usually spend money on what's important to us. So if you can figure out a way to have a money date with your spouse, you and your spouse will just conversating, sitting down, maybe make it a more technical money date, like once a quarter, where you pull out like really hard number spreadsheets, things like that. But one of the points she definitely pointed out that was a strong one is that you don't want to wait until 9 o'clock at night after working all day to try to have a money date. That's not going to work out well. That's going to lead to nothing but arguments, and nothing's good coming for that. And then you also want to look at the fact as to where the market is right now, where the world is right now. We have inflation going up. We have wages going up. They're not keeping up with each other. The job market seems stable. Where are we going? We have the geopolitical conflict, which I guess we can go into right now. And once again, remember, these are all things that are in the Main Street Meets Wall Street newsletter over on LinkedIn. This is the X version that we're looking at right here that we're reviewing, the article. But yeah, geopolitics, man, they just keep going into it. You can't seem to get enough of these geopolitical events happening all across the globe. Question that was asked to me. What do you think if this conflict turns into a regional conflict? And, is this not already a regional conflict? You got to look at geography. Look at the multiple points of engagement already. If not just by Iran, but by Iran struck a lot of people out there. They, immediately retaliated when this actually already began back in February. And maybe it really began when we bombed the nuclear site at the end of 2025. But I don't know. It seems like there's more people involved every day. I think Hamas agreed to an agreement with President Trump as recently as yesterday. But see, these agreements and these memorandums, they're struggling to stick right now, to say the least. So what we're seeing from them, the memorandums of peace, that's clearly been violated. Shots are being fired. We're back to kinetic warfare. There are reports that Ukraine hit an Iranian ship. I don't think Ukraine denied it. So it's just, this conflict seems to be here for a while. Some reports, and once again, I'm not a geopolitical reporter. Some reports are that Iranian folks feel like they can last longer than we can due to our political situation where we have elections. They don't have elections. It seems like the goals may be changing, but here's just some things for us to think about right here on Main Street, right? Gas pump and voting booth. Like, how long can the average American consumer absorb these elevated gas prices? For it, it just completely dominates the election season. And gas and oil is a big part of inflation, right? What we saw when the war began, we saw really high inflation prints. And then we saw the price of oil come down. During this conflict, we saw inflation prints that were lower than that. So inflation we're seeing it with the pumps, and people are feeling it, right? As prices climb, discretionary spending has to slow down because you only have a finite amount of dollars in your budget. It seems like $100 a barrel. We keep seeing it go up and down around that place as a benchmark, right? So we've seen $100, whether it be WTI, so West Texas intermediary, or we see the Brent crude oil, either way, up and around $100. And then you got to remember, those are priced like future prices. So those are priced a little bit different, but there's swings up and down. We had Exxon report yesterday, and Exxon missed some of their numbers. Then we have a company like Chevron report yesterday, and Chevron reported blowout numbers. But investing in oil, people want to invest in oil when they saw the war start. Like that's another thing. So I won't go on a tangent. I won't get too far off on the subject. Like when you're investing, it's just another reason why a person should have somewhat of a diversified portfolio where you have all your areas covered. So you're not chasing oil. You just already have these oil producers inside of your portfolio. So if they do move, maybe it becomes oversized just due to the growth inside the stock position, the stock price. Like the stock price just continues to go up. And then at that point, once it reaches a certain level, it would be prudent to trim some of those gains. Because in the long run, energy is a very fickle thing to gain money in. But in situations like this, we see elevated oil, so you can't go in there chasing everything either. And then it seems like there was a while where we had the Monday through Friday, there was peace, and then over the weekend, they were fighting. And the markets were resetting every Monday. But that seems to be passing a little bit now. They just seem to be fighting. I know we took a break or a pause a couple of days ago. People were concerned about whether or not there are enough munitions for these battles, where our stockpiles are at good levels. Once again, I'm not a military expert, but the thing about from a Main Street perspective, or even if from an investment perspective, if you think we need more missiles, you have to look at companies who make the missiles, who are making these missiles. What do you use in war, right? We have the drones that we're trying to use, trying to find a lower cost of war. But like I said, the oil, we use oil for everything. Oil is used to transport things. Oil is used to make energy. There's just so many different ways that oil is used, and it's actually like synthetically inside things as well. So oil is inside a lot of products, petroleum, whatever you want to call it. Our supply right now, we're going into the strategic reserves, probably at a faster rate than we anticipated. I think this war is being drawn out longer than some people anticipated. When I was asked about it in February, I said this thing could last years. I don't know. Hopefully I'm wrong, but that was when they were saying it was only going to be 6 to 8 weeks, maybe, or 8 to 12 weeks. So it's definitely longer than it started out, and probably closer to a year no, it's not close to a year yet. Starting in February. So we're entering what would be the 6th month as it's the beginning of August. So, but like I said, that's why you want to be in a constructed portfolio that's well balanced. You want to have exposure to defense and energy already, like in proportion to size. The equal weighted market has made such a strong return this year. And I don't mean particularly market return. I mean like a return to prevalence. People are using it again. People are investing into it again. As we saw with AI and the Mag 7 and tech, we saw that the concentration was so high in those companies. We saw the concentration was so high, it was almost 40% of the S&P 500, which is cap weighted versus equal weighted. And we talked about that in a video I posted earlier this week. You want to go back and check it out. We're talking about IPOs, Apple, why Apple always wins. What 401ks, we actually want a little history dive of 401ks and why people invest in them, why they should invest in them, why they do invest in them, how they came about with the death of the pension. But I was saying before, so we're seeing rotations inside the market back to an equal weight. That cap weight was when it was nearly 40% of your portfolio. Think, like I said, with Asia and the Kospi over there, where you have pretty much two stocks, Samsung, SanDisk, they're making up the whole entire over half of the index. And when you see those go down, you saw the drastic losses that we saw over there this week. And we saw sell-offs inside of America as well. The week finished strong, but it was choppy. It's very interesting sessions, interesting data. But like I said, we're going back to the markets and market dynamics. So at the end of the day with the markets, it was a big week for earnings. And the last week had like 4 hyperscalers report last week. Well, I guess this week, but the week before we had Alphabet or Gemini report. This week we had Meta, Microsoft, Apple. So yeah, and here we're talking more about it. The thing that investors seem to be concerned about return on investment, and free cash flow. And how are we funding the AI build out, right? Are they funding this AI build out through free cash flow or through debt? How is it being funded? Those are some of the big questions that are being asked right now. That's what people want to know. And with regards to it, I would say both. We'll just look at it. And this is all in the newsletter. So please check out the article on X, check out the newsletter over there on LinkedIn, subscribe to it. If we're not connected on LinkedIn, let's connect on LinkedIn. Check out the ABC Square. That's the company page is where it's at on X. I don't have a personal X page, but the company has an X page and then the YouTube page. So, and this will be on the YouTube page and the Main Street Meets Wall Street podcast. This information is out there if you want to receive it. We're out there. We're putting it out there for the world to see. Like I said on the podcast, we have a lot of great people in there, and we still have more people coming up. Just finished recording one with Sarah Grillo. She brings a lot of great information. Tara Ross, we have his episode coming up where the Bitcoin bull case is coming up. That comes out this week. Part one of that. We had the Bitcoin bear case for folks who want to hear the bear case to Bitcoin. We have war reports going since the war started where we were doing some live sessions, and we also had some record sessions, and we just put them into hour-long sessions that you can sit back and watch and see the war kind of document in real time. So the war report's a very cool thing. Then we also have very cool guests who come onto the podcast and break down things for us. Help Main Street Meets Wall Street. So it's usually with the guests when we do it Tuesdays, you can catch the episode with the guests, and then Saturdays, something like this. Saturday, Sunday, over the weekend, we like to release something a little bit different. It's usually just me solo breaking down information or some things I've been quoting in the media. I don't want to go too far or digress. Another big thing, which actually I think could actually tie all into this AI play out, AI build out. And if a bubble was to happen, is the buy now, pay later craze is going on. And I say craze because it's starting to get really extended. That leverage that people are using, and people are getting into the wrong mindset with it. Stories of people who are ordering $40 worth of Chick-fil-A while living at home with their parents, splitting the payments, not because they have to, but just kind of because that's their condition. It's easier in their mind to pay it off. And if you can't pay it off at 0% interest, I get it. Cash is tough, affordability is high. But if you don't, these buy now, pay later loans end up becoming pretty much like credit cards, where you have high interest rates that you have to pay it back, and they could impact your credit in a negative way. Because some of these do report when you make payments on time, but I guarantee you when you aren't making the payments, you're going to report them. So you have to look out for your own time payments, and then the payments that you don't make on time. So buy now, pay later. Just be careful with it. Watch out. Be careful if you're out there doing it. I always think about like layaway, but the thing with layaway is you didn't get the product in layaway until you had actually paid for the product. So that's a huge difference from what we're seeing right now with buy now, pay later. Buy now, pay later. You're literally buying it, getting it, and paying later. So if we see that, we see a consumer continue to struggle there, that could be another sign, something that's coming with busting a bubble or a bust economically. And people blame it on AI, whatever sector may bring to them, because AI has been the big buzzword. But like we said, Meta, Microsoft, they both reported different results, right? Meta reported they were going to spend more cash, but they didn't necessarily have a clear path. I think Zuckerberg he's been penalized before for some of his spending, excessive spending. It seems like he chases dreams sometimes, but I guess that's how he got to be where he was, chasing dreams and creating things that other people couldn't see. Microsoft had been underperforming all year, but they gave a great quarter. They gave great guidance. They have a great plan for their free cash flow, and they said they're going to reinvest too, but we saw their stock have, I think, its best day in like 20 some odd years. One of the best days in the index in a long time as well for the overall stock index, just by a market gain and market share. So, but then we go back with Google the week before, and Google increased their capital expenditures for the AI build out and managed the liquidity and equity issues. I think Alphabet was initially down, but it's come back since then. So it's not like Meta is still being punished. Apple reported Apple stock was down initially, but Apple had been one of the best performing stocks in of the hyperscalers for sure. It was the winner. It had overtaken NVIDIA again as the world's most valuable company. So semiconductors continue to get punished as the rotation happens in this market. Once again, that concentration risk that I was talking about. But we see semiconductors that got destroyed. And like if you just look at the Philadelphia SOX or the SMH, two semiconductor indexes versus like the IGV, that's a software index that covers software companies. You saw that flipping all of it. And then Oracle. Oracle, oh my goodness. Oracle is the poster child for AI spending and wage spending and whether or not this is going to be one of the AI winners or losers or how to go about AI. First in, first out with Oracle, maybe because they were one of the first ones to come out and say how much, not say how much they were going to issue, but issue out a lot of debt after their blowout report, because they did pretty much right after they had a blowout report last year. Like we said, we saw the stock skyrocket up over $300. And now the stocks got hammered back down like the 120s, and the stock stock has some momentum. That's a low level. But it just illustrates how sensitive Wall Street really is when it comes to capital expenditure spending. But Larry Ellison has a track record as well of leverage and people thinking he's down and out and somehow pulling it off. You don't get to be one of the richest people in the world by not taking risks, almost losing it, and making it back. Look at pretty much all the richest people in the world. They've had some move or some sort like that. And not to say that wealth is a measure of anything other than dollars, right? Dollars are not wealth. Wealth is different for every person, but you need a certain dollar amount to function in the world, to live in the world, to meet Maslow's hierarchy, where you're not worried about sleeping or shelter or feeding yourself or your family, right? Then you start thinking about wealth and things above and beyond that. But like we were saying, the Cosby, the concentration and leverage, you want to see the real world warning shot regarding concentration risk and systematic leverage. Like I said, look at South Korea. That Cosby index was so heavily concentrated, right, that they had to call in the foreign minister. That dude was about to lose his job and decrease some of the leverage. They took some of the leverage that you can have over there anymore. You can't be 3, 4, 5 times leverage like they were before. I think maybe you can have one leverage now. But leverage, like I said, can magnify your gains, but it can be terrible on the way down. It will destroy your capital faster than not at a casino. Position size is just as critical as risk management, like for real. You have to, because if you're over, position size is a part of risk management. So if you're over extending the position size, like we were talking about, like say we're diversified in our portfolio, we have the oil companies like Chevron and Exxon, and then they grow. Now this position size has grown. Or even right here with the Cosby, maybe you got in the Micron, which isn't a Cosby, just like the memory trade is also tied in this. We saw the memory trade go away, the DRAM trade. You have one of those companies and they're getting just killed or punished, and you're leveraged. You're going to see it even worse. So be careful with leverage, margins, shorting stocks. Just if you don't understand all these things, you don't trees don't grow to the sky. Just figure out your risk tolerance and invest based on it. Don't chase the next best thing. Know your investment thesis. There are a few reasons why you should change it. Few things happening in the world that'll make you change it. You have to know your investment thesis and know why. Speed investment thesis and knowing why. I was speaking with David Snyder, the man who predicted the .com bubble, and a CNBC mystery broker to Michael Santoli. We were speaking about he sees the AI. He sees the AI as a bubble. This was a few months ago. He was telling me with the AI bubble, I was like, what are signs people can look for a bubble in the AI? And he said, well, one of the things people can look for will be SpaceX, OpenAI, Anthropic all coming out and going public. Because once they all come out and go public, that'll be a lot of capital. He said pretty much most of the capital is exhausted. One of the things, one of the signals that you look for. So we're not going to get too deep into whether it's a bubble or not, but we're going to talk about these IPOs. A couple things to note with IPOs, like lately, vast majority of IPOs are down like 50%, 12 months after your listing date, right? So think about SpaceX. some of the gains we saw in it, 220 post IPO, but 135. So I guess technically you could see it hit 65. I don't know. The 60 levels, or it could surge back to 200. SpaceX is a little bit different when it comes to that. SpaceX has the cult following. At SpaceX, the cult following, so like from Tesla, some of the original retail investors, like GameStop, meme stop type things, were like Tesla investors before GameStop and meme stops. So, and if you live on this planet, you know that there are few people as diverse, and not even from, well, maybe from his actions, but we're not getting to his actions, but that people have such diametric views of than Elon Musk. Some people will continue to buy this stock because it's Elon Musk. Some people will never buy this stock because it's Elon Musk. That's for each his own on that one, Main Street, but you'd be you would have a lot smaller pool of stocks to choose from if you invested based off the person that runs the company. I'll just leave it at that. But another thing that came out with SpaceX, people were expecting SpaceX to buy Tesla, which could still happen. But SpaceX has the government contracts, and the SpaceX was to buy Tesla. And this was reported, or a leak. Elon Musk actually denied it, that Tesla would be divesting from his China interests in some sort of separation, or some sort of pulling apart of the company. Oh, that word is leaving my brain right now. But like, well, Honeywell did it, GE Verona did it. Where you break it down for the sum of the parts. But they could do something like that and then leave the interest in China, and that way you wouldn't have to worry about the security interest. But Elon Musk said that had not ever been reported or ever even talked about, and that was faulty reporting. But we'll see. I think China has a different type of set of rules if you want to leave China, or maybe you want to stay in China. Either way, I think China has a little more control on their companies than America does for now, anyway. But like we said, we got OpenAI and Anthropic preparing for their public listings over the next 12 months, and people really talking about the circular investments again. It's part of the reason why we saw companies like NVIDIA take a big hit here recently. We saw tech giants that are investing in NVIDIA actually made another investment into, I think it was Anthropic, earlier this week. I discussed that deeper in one of my videos from earlier this week. But yes, we see that right there. And people are wondering, where exactly is this money going to come from? Where's this money? How's it getting back to them for this cloud computing? How much it's going to cost? And then you have reports coming from China, where the Chinese companies are building these products out and building out these same type of things for fewer costs, less tokens, cheaper type tokens. Because now it's becoming about tokens and tokenization. Cost of tokens, cost per token, what kind of quality are you going to get from your work for a token? When they first came out, I realized it was about tokens. People were buying tokens and token maxing, and then I think corporations just say, oh, that's really expensive. We need to pull back here and figure out a more efficient way. And then, like I said, you see the China companies coming out over there with models that are just cheaper models. I think we saw, maybe it was Alibaba that giving some NVIDIA chips to some companies in China, smoking some over there to some companies in China, and they just build off of those NVIDIA chips to grow their AI companies. They like go in there, clone them, and increase their increase their AI capacity. Obviously at a cheaper price. I mean, if you're getting it free, it's pretty much a lot cheaper than what they're paying. So you have that, the circle investment. We just saw people a lot of concern with AI and the AI build out. And then also with the way AI is financed, and we saw the leverage go into effect from the private investor who Ken Griffin and the Citadel came in to quote unquote save. His fund was up to like 45 billion, but it was so highly levered. I think they probably sold it for parts for like 10 billion, and I say that like that's a little bit of money. And who knows what Citadel's going to do with it. But I'm sure Ken Griffin has a plan for it to make multiples on that investment versus what they paid for it. But it was highly levered into like memory stocks and into the Kospi over there, and when it worked, it worked. But when it stopped working, like these are rotations and these are realities of the market. Like when it stopped working and when it has that much momentum, it's just whoosh, you can be hit really hard. People's life savings, their trillions of dollars just wiped out. Speaking of trillions of dollars been wiped out, like an example, So when SpaceX first came out, it initially made Elon Musk a trillionaire within like the first week, maybe like within the first weekend, they bought a company for like several hundred billion. The company they bought actually was pretty much the same amount of market cap that they had gained in stock price over that time, which is interesting in itself, before the stock went back down. But they're taking some of that money and were buying other things, growing that company. Like I said, this goes back to circle investments, maybe. But here we are, and we're at the equal weight, like how the markets are moving. Capital is moving away from that hyper concentration back to equal weight indexes, one equal weight index. And this is a stock recommendation. None of these things we've said, just to repeat, are stock recommendations, but they're just stocks that you can look at. So capital is moving away from the hyper concentration. Small caps have been leading for like over a year. I don't think people realize that. Small caps have been running. If we do get rate hikes, that could definitely do something to the small cap rotation that we've seen, because higher rates will impact smaller businesses more than they will impact larger business. We recently saw 50% tariffs implemented on Canada. So how will these be passed through down to corporations, to consumers? And then, we got the debt wall going on. So we got the metric flash when it signs $40 trillion. And then that serviceable debt's like 160 trillion. So a lot of debt that we have to service right now, which ties back into the interest rate conversation that people are having. Will we have lower interest rates, which will make it easier to service the debt? That's why people ask, will we have lower interest rates as well? Make it easier for people to buy homes. And these are all in theory, with the rate cuts, right? Because the truth is the Fed cut rates several times under Jerome Powell, and the stock market went up. So you had several rate cuts, and then you had the stock market go up. So where is the stock market going? I think you're going to see more bumps in the stock market and volatility until we reach the election. Then hopefully we have some clean, clear elections that can carry us in and through the stock market. Once the stock market has clarity, I expect it to go up. But we'll see what happens in between now and then. A lot of volatility, a lot of things are happening. Like I said, we still have a war happening right now. Tariffs are coming back. How are these tariffs implemented and impacting the world? How is inflation hitting consumers? Which one of these big companies that everyone's banking to win is not going to win? We'll see. Or who's going to zero? Someone's going to zero. We haven't even talked about crypto. Crypto's a thing that seems to be coming back as well. But just a lot going on. And then cybersecurity, right? So we're talking about a little bit about cybersecurity. Over the last few weeks, we've seen Anthropic's model, I think it was Anthropic's model, hack into other places, hack into other companies, hack into other models. Hugging Face is one that hacked in, and it's doing this outside of the parameters that it's being trained to do, right? There you go. Claude Anthropic, right? Yeah, so Hugging Face goes in there, and then I think as recently as yesterday, they announced like 3 more interfaces that were breached. These AI models are supposed to be in sandboxes, but they're getting outside the sandboxes. The first one, it was supposed to be a test, but the AI model decided that the test was too hard, or maybe it just decided there was an easier way by going into, instead of solving the answers for the test, just go to the source for the test. So one thing to think about with that is, back in the 80s, 90s, Microsoft really dominated the world because it had enterprise like software that people could put on the computer, and it was in everyone's operating system. Pretty much you had to have Windows for a while, a monopoly. I believe they got sued for it. If I remember correctly, Microsoft got sued for that. Could cybersecurity be the next layer like that? And there's a company that's leading like CrowdStrike, or is that going to be like the next Microsoft? Once again, not investment advice, not a single stock recommendation, but is CrowdStrike or Zscaler or Palo Alto, or is that a company that's going to be like Microsoft? Now we're seeing the increased need for cybersecurity, especially with large amounts of capital. Not to mention a company like Palantir. Palantir is really deep with government contracts, and they're so layered inside of defense and cybersecurity. Maybe they could be a winner inside of this movement. to cybersecurity, but cybersecurity stocks also they go strong with software. I don't know if people remember back in February where we had that SaaS apocalypse, and it just kind of became a rotating SaaS apocalypse. Um, Cybersecurity, financials, every industry. I think the trash industry got disrupted 1 week because of something with um, AI. We saw all birds go from a shoe company to an AI company. So just rotating AI bubble popping around, right? And that's another thing. That was another question. Like I said, people asked if there was a bubble for AI. And I would say, I actually did say, so this is how I describe it. I don't think it's a bubble per se. If it is, we're all in it. We all know it. But it's like a building. I got even deeper into my thought about it from where I answered the council. So it's like a building. It's like when you're building a building as well. So you gotta put up like the framing, and I don't build buildings, right? You gotta put the framing on the inside or whatever you're going to do, but you gotta put up the four big walls outside, however big the building is, right? You gotta have four walls. So like the AI, in my opinion, is like so far as the four big walls, this is a huge building. Then they're going to break off into different sections, like rooms inside the building, and that's what's happening inside AI. So like different rooms are popping and different rooms are bubbling, that pressure is going, but it's all the same. It's all in the same house. Hopefully the whole house doesn't catch on fire at one time. So maybe that's the difference of what we're seeing right now. So is it a bubble? If it is, like we're in it and we know it. It's irrational exuberance all over again, perhaps. Is this time different? They rhyme, but they're never really different, right? But they're always different. They're different calluses, I guess you should say, right? Whether it be the 87 crash from that stock market just running hot, whether it be, the 99.com bubble where that stock market went hot from everyone thinking that internet was going to change the world, which it did. I mean, if it was for internet, we wouldn't be sitting here doing this right now and having the AI conversation, to the housing bubble, which the world knew about. Well, not the world, but people definitely knew they were putting together trash products and junk and selling them. And they were essentially betting against the products that they were putting out. I digress. That really ruined a lot of stuff for people of this generation right now. There are a lot of people who were children in '08 and saw their parents lose their houses and have to move or lose their jobs or get divorced. It's just a lot of things that came from a situation that could have been avoided. You just can't give subprime mortgages to everyone. People who can't afford it. Again, and we have to know where we're at inside this bubble and be positioned properly. Okay. We talked about concentration risk. I spoke about concentration risk inside this conversation as well. Like inside your portfolio, anything you're investing in, you can't have, a simple way of saying is you don't have all your eggs in one basket. What do you think about building our portfolio, right? This isn't once again, a stock recommendation or a plug for Apple or any individual stock, but Apple seems to win, right? We'll talk about why Apple wins in the long run. There's an article right there in the video right here. And once again, this is all in the newsletter that I wrote for LinkedIn. It's a long newsletter, but this is the article on X right here that we're reviewing. It's just reviewing the markets in the month. But Apple wins in the long run. Not a recommendation for Apple, for or against Apple, but why does Apple win in the long run? Like, just think about it. Apple sent me a message the other day, said they were increasing my Apple Music price, and I didn't cancel my Apple Music or my Apple monthly subscription. They only increased it by $1, right? So we're in here and we're seeing a water boil, or we're going to jump out. I don't know. We'll see. Everyone else was spending so much money on CapEx, capital expenditures, right? Last year, and Apple stock was being destroyed for it, being destroyed for the capital expenditure because they weren't spending money, right? I said to other people, I said it's a good bit, like the early bird gets the worm, but the second mouse gets the cheese, right? And Apple may be the second, third, fourth mouse, right? And I got a video on this from earlier this week where I go deeper into Apple and all of these things as well as why they win in the long run. And they just reported and their stock actually went down. So maybe that's an opportunity to look at a stock like Apple. And it doesn't just have to be Apple, but we are going to talk about Apple right now, like Apple specific. But people were being rewarded for spending money last year. And now we see with stock, people are being punished for spending too much money if they don't have a clear plan of where that money is going. So they were burning through their cash on data centers and free cash flow. And Apple has a fortress of a balance sheet. Apple has more cash than a lot of countries in the world. Like Apple would be one of the larger economies in the world just based on how much cash that corporation has. And Apple has so many levers and so many things that they can pull, so many things that they have invested in, Apple phones, Apple devices, Apple subscription, Apple TV, just so many things with Apple. And then just to bring in with Apple, like half the world's already built in as Apple users. And people usually don't switch. So then they have the partnership with Google. And this is another thing. People hear these things. This is all on the media right now, like the mainstream media. There's Apple stuff. Go get Apple, go get Apple, go get Apple. But other people have been talking about it. I was talking about this Apple for over a year. I've been talking about this for Apple for like well over a year. Pretty much anytime anyone asks me about Apple, I'm like, yeah, it's probably not a bad time to invest in Apple. Once again, not a stock recommendation, but reasons why, and people say Apple's price highs, price over the market multiple, like 35, 37, 38. Well, Apple's a premium. It's the most valuable company in the world by market cap. So you're probably about to pay a premium for that. You pay a premium for premium products, but you also should expect a premium return, which Apple had not been delivering for a while. A premium return, like we said, we saw the stock trading sideways and trading down, but now it's been one of the better performers this year until recently when they reported. And I was asked a question on South Korean TV, K-Pro TV, earlier this year, asked about, and Apple or Alphabet. And like I said at the time, it's hard to go wrong with either one of them, but I do like Apple. And this was a time when Alphabet and Apple had just went into their strategic partnership. Apple is paying Alphabet a subscription fee for them to use it. But at the end of the day, you got to realize that it all comes back to Apple, right? People always come back to Apple. All these tools, all these platforms, whatever OpenAI is building, it's going to be on Apple. All these AI interfaces, the Uber app, whatever you're thinking about, is going to be on your iPhone. At the end of the day, people just want to tap that app and get to it. So the app store is so powerful. Apple's now a rosy, right? Like I said, you have the multiple that's above the market level. So there are definitely opportunities for companies with lower multiples, although the multiple probably came down some with the price depreciating this week from the stock selling off a little bit, but it had been on the run, a great run. One thing to look at is the leadership transition. Apple has coming in. Tim Cook is taking his final earnings call. That was Sunday, or I'm sorry, that was Wednesday. So the next one will be from John Turnus, who comes in September. Watch out for his expansion plan. We'll see. Like I said, Apple has already built in a lot of user base. Apple went and spent a lot of money on AI. Apple has kind of said a couple of things that they want to kind of do now with AI, maybe playing some stuff with Siri. And Apple's hardware failures have been of note here lately, right? I think the 17 got a better response than most people expected, and now they're launching 18. So perhaps with those product launches of the hardware, we can see some appreciation as well, like see some growth towards earnings in Apple. But you also have to remember Apple, and people were calling for Apple to acquire something last year. Why is Apple not buying this? Why is Apple not buying that? Apple hasn't really been making a lot of acquisitions. They have had a lot of brain drain, so a lot of people leaving from the top. But Apple is built to last. People thought that Apple was going to be, dead in the water when Steve Jobs passed away and Tim Cook took over because you have Steve Jobs, who was a visionary, then you had Tim Cook, who was a supply chain guy. Turns out you need a supply chain guy for COVID, right? When the whole world shut down, you needed someone who could navigate supply chains. That's one of the reasons we saw Apple continue to not just survive, but thrive during that time. They had stock split. I remember the stock was down like $100 when they did that split. So Apple's a strong play. Once again, not stock recommendation, but find a stock if you are looking for like a stock, some type of stock. Find a stock like that, right? So that's what I mean by like find an anchor stock. Find some stocks that you can grow on. And if you never invested, you probably should base it on some type of index or ETF that mirrors the market, right? As a big part of your core position, right? Think about like you have a jar. You got rock, big rock that is most important. And you have little pebbles. Then you have sand. Pebbles are kind of important. The sand is just like frivolous stuff, right? You want to fill but all of it makes 100% of your portfolio. I don't want to say frivolous, it's smaller, right? You got to figure out how to fill that jar up, which the lid's going to be smaller a little bit than the rest. It's going to be kind of shaped like that. So you got to figure out how to fill that whole jar, right? If you just put the big part in, you just put the rock in there first, and then you build around it, are you going to be able to get everything in there? So maybe you want to build your base with a little bit of that sand, right? We can say that the sand's like small caps, right? So you have a little bit of that sand in there, then you put the rock in there. It's taking up a lot, maybe some large cap allocation. Then you put the pebbles around it, the mid cap section. Then you got the whole portfolio in there. You got everything inside the rock. And it's not over proportionate. But like I said, if you're doing it with like market indexes, something that's just mirroring the market, that should take care of that for you as far as like diversification. Make sure that you have everything inside your portfolio. Because once again, with Main Street meets Wall Street and the conversation we have, trying to give you actionable steps that you can take and things that you can do, ways that you can grow, like things you can do today, tomorrow, like things that you don't have to wait and do, things that don't seem um, so downtrodden for people, right? And then, like I said, so back to equities, capture the headlines, but bond market's big brother, right? When Warsh was speaking, Treasury yields pushed higher. The bond market looked at the Fed and simply said, man, you can say whatever you want. You keep talking about that 2% target, which you hadn't hit in 5 years or longer. And, inflation's the closest it's been has been in the threes, right? Low threes, maybe it touched some high twos. But Kevin Warsh also said his inflation numbers, he's looking to the left of the decimal, so he wants that too. Then he said, so this is more of the Warsh talk that we're getting, that he is concerned that when he says 2, I think he means 2.0 for an inflation target. Different from the first speech versus the second speech he gave. But we had the huge stimulus injections. I mean, pretty much across multiple presidential administrations for decades, right? Like, let's be clear on all that. It's not just Biden and Trump who did that. And now people are going to turn to Jackson Hole in August just to see, which isn't, quote unquote Fed meeting, but he's definitely going to come out and say something. As Warsh said that he would speak for the Fed, committed to give speeches for the rest of this year. He will reevaluate after that. So he'll speak in Jackson Hole. He'll speak at the September meeting. I think they have maybe 2 more meetings after the September meeting. So he'll speak for those. But the market should adjust to like Kevin Warsh's style right now, that what Kevin Warsh is saying is not, he wants the market to take care of it. The market's going to make the Fed do something. They're not just going to sit here and keep letting Kevin Warsh make the market take care of it. So it'll be interesting to see. But you got to maintain proper positioning. You got to schedule your money dates, folks, and you got to be in this for the long term. Don't let the short-term noise and short-term signals distract you from what you're doing, from where you're trying to get to in life. From the goals that you have, from the economic principles that you've based on your plan, unless any of that's changed, stay in there. If anything, maybe you need to double down when turmoil comes in the markets. Because guess what? Every 5 years or so, the market's going to get hit. And you're going to lose a decent amount that you hold. Considering if you've been inside this market the whole time, you've just been watching it go up, it's going to feel like a real big amount. But what you have to do, and this is where financial professionals or someone else can help you generally, because it's hard for us to have that mindset alone, is you have to remember why you're invested. And if you stay invested, history's shown us, and I can't speak for the future, but history has shown us that if you stay invested through these market downturns, and when market downturns happen, you'll be rewarded markedly on the other side, like multiple. We've seen some generational wealth. Like I said, I walked into the room and I told, I said, Marcus Sturdivant Sr., go down here from the Wall Street South, Charlotte, North Carolina. And I was in Atlanta, and the Atlanta folks looked at me like I was crazy. But y'all gotta watch out for Charlotte. Like I said, we got $4 trillion in assets. We got BA here. Truist is here. Wells Fargo has a big thing here. Financial heavyweights, like Truist came here when they were in Winston-Salem. Wells Fargo's got their most employees here. And then pretty much every major center is here. Even JP Morgan just came down here. JP Morgan Chase came down here. I think it was the end of last year. Saw Jamie Dimon doing an interview from an office. This is in Charlotte. A lot of financial workforce. I know a lot of people who work in the financial workforce here in Charlotte. Charlotte's one of the biggest and largest growing cities, and our mega banks control a lot of our local deposits. So, like I said, Charlotte is just, where the Wall Street is South. Sorry. I mean, it's not a bad thing. And a lot of people are like, oh, it's what it is. Like, Wall Street is South represent. That's pretty much the newsletter that we went over. Like I said, if you want to read this, it's a 10 to 15 minute read, but it's definitely worth it. If you want to go more in depth on some of the things that we were talking about. Some other things that, just so you're not reading the letter the whole time, just take a few minutes and wrap this up real quick, We did get a GDP report. It came back a little bit lower than expected. So we're seeing GDP maybe contract. We'll see how that works out. But that was, we had the war in Q2. So Q2, AI valuation reality versus the actual premium that we're seeing in this market. Don't let AI and AI build out have you over concentrated inside your portfolio right now. Because we've seen that whipsaw goes both ways. Then we talked about estates, family money dates. Make sure we are planning these money dates, that you're sitting down with your loved one, you're preserving your wealth, you're doing the things you need to do. Y'all are having these conversations. Make sure they're structured. Make sure they're really happening. Some things you can do, like I said, actionable steps. Make sure you have beneficiaries designated on your accounts. If you remarried or something to that effect, make sure you have proper updated beneficiaries, because I don't think very many people are going to be happy if they pass away and their ex-spouse, while they have a current spouse, gets the stuff. So make sure you have those updated. Make sure you have rebalancing set up the way it is. Make sure your generational transfer strategies, they align with tax laws. Like, if you want to set up a trust, you probably should spend some money and get a trust attorney to help you set that thing up the proper way. And then just remember, the Malcolm Jamal Warner situation, just because you have a prenup or a trust, or whatever you may have, things can change and people can contest them, and we'll see how the law plays out for it. We say will oil hit $100? That's going to be a big level. If oil hits $100, and then maybe we'll see interest rates. And this isn't necessarily saying that they'll be tied together, but they could be. Oil, $100, interest rates at 5% for the 10-year. The 10-year is like 4.7 right now, but if we see the 10-year is like 5%, people are conditioned in their mind to go more risk off because they feel like 5% risk-free is a great return. I would say, is it really 5% risk-free though? First of all, everyone could default. The U.S. government probably won't. They never have not paid a bill. But if it's 5% return, and then you are, let's say inflation is 3.5%, you're really only getting 1.5% on that cash back in real return, which is another reason why equities generally outperform in the long run, because you generally get 7 to 10% historically on equities. Like, if you look back over the last 100 years, let's say when inflation, there's a reason why they say 2% is the target. Let's say it's potentially 2%. That's a larger real return than if your cash was getting 4%. So we'll see how it goes. We'll see how portfolios are hedging against it. We'll see if gold comes back into play, if metals come back into play for more than just the AI build out. So we'll see if the actual precious metals become a thing. So that'll also be a sign that people are worried about money and the stock market. We've seen the dollar firm up here just continue to go up. So that would also be another thing that could be impacted by interest rates. And we're seeing, maybe as the dollar firms up, people are saying, yeah, we think the rates are going to go higher for the cost of capital. CapEx, cybersecurity, right? So tech earnings, you got to look out for CapEx. We need to see where this money's going, where they're spending these dollars, where they're actually going right now. This IPO window is going to be key. We've seen several of the big ones push their announced date back to properly the beginning of 2027 or some point within the next year, whereas people would have thought that probably all three were going to come this year. Watch the earnings with the cybersecurity, right? Because if they continue to spend, it's eventually going to compress your margins. I mean, you can only spend so much with the earnings before you take it away and you're in bad shape, like really bad shape. And that could just happen overnight. So watch how these firms are financing their debt, how this debt's being financed, and where the money's coming from, and what's the ROI is, return on investment. And then, like I said, Charlotte, man, we're the Wall Street of the South. Like, people can hate, people can say whatever they want, but Charlotte's the Wall Street of the South. I want to take a minute and just thank people. I want to thank y'all for the people who tune in, the people who read the newsletter, people who listen to the podcast, the people who support the channel, the people who pop in and say like, share, subscribe. Like, appreciate that stuff. I want to show you the newsletter. Like I said, that was the LinkedIn version that I just showed you. I mean, that was the X version. Here's the LinkedIn version. Like I said, we're sitting 1,400 subscribers, over 1,400 subscribers. I love that picture of Warsh and Powell. And then it's the latest edition right here. So it just came out. And it's a 15-minute or so read. But it also has videos in there to, help you dive deeper into some of the concepts that we're talking about. So video there with Mr. George Hoppenfuller. Sorry to go so fast. The debt, we're talking about the debt in one of the videos, is a chart of wealth right here, a wealth of knowledge. Actually, now talking about couples and money, reason money and couples. That was a great conversation. 2 parts to it, actually. Then actually one with Mr. Derek Kinney. Derek has a great conversation, ways to think about the economy and volatility. You're an advisor, how to talk to your clients during these times, or how to grow your business, or whether you're just dealing with your own personal financial economy, which all of us are, right? We all have our own personal CEOs or personal financial economies that we're dealing with and that we're trying to grow. So his is great for that. And then, oh yeah, great conversation with Ryan from over at Benzinga. Great conversation. He hosts the Pre-Market Playbook show. We just talked a lot about noise versus signal. Ryan's a Bears fan. For those who don't know, AI made that shirt logo. I don't know why he made it like that. But Ryan's a Bears fan. He had on Bears shirt. But you should check it out. It's a great conversation, and just some of the things they're doing over there at Benzinga. It's really, really cool stuff. I actually have a Benzinga link that I can put into leave in the show notes for folks so you can check it out. Use my link, and I may be compensated, but it won't cost you anything extra. Speaking of Benzinga, there's another conversation I had with Benzinga with Brad Olson, the chief content officer over there at Benzinga. So that was a great conversation as well. And maybe part 2 of 2 with Brad. And then we talk about the cybersecurity. And then that's the video. So I was talking about a video I did earlier where we were talking about Apple and breaking down some of those companies. That's it right there. So, and also in the backside of that video, I take like the last 30 minutes to talk about just 401ks, history of 401ks, like how they were written out until like 1978. They were pretty much a loophole that someone discovered in the early 80s. Like, they were only for high-ranking executives. It was kind of for executive compensation is why they came about with the 401ks. And then people realized that there was an evolution and how 401ks actually meant, a good reason to push some of the honest back onto the individual. So we talk about defined benefit plan versus defined contribution plan in that video as well. So for that, just real quick, high level, let's say defined benefit plan. You're going to get X amount as long as you're going to get this benefit. Think of pension, you'll get an annuitized amount of money for the rest of your life as long as you put in this amount and follow these rules. So that's defined benefit. Whereas with defined contribution, where it's just say, if you put this amount of money into this plan, you may get this return. It's not a guaranteed benefit. It's up to you that you do it, for one, that you put the money in there, and two, you pick the investment plan. So that's defined contribution, like you're defined that you contribute. It, once again, just pushes the onus back to the individual. And then right here, we have a deep dive on SpaceX IPO. That video actually has several interviews from SpaceX's, like straight from their mouth, the CEO, So yeah, Musk is talking to CFO and they're talking about their vision. It goes through your history. So it's a good conversation right there. And then for anyone, like I said, this is the LinkedIn version. So anyone who wants to roll on LinkedIn, like how to make a good post, what people are looking for on LinkedIn, why LinkedIn is great, what LinkedIn is good for. That conversation with John Tomasi is right there on the newsletter as well. So like I said, the LinkedIn newsletter is a lot, this one. And then it also has the podcast that you can check out, link to the podcast and link to the YouTube channel. So yeah, Main Street, that's a lot. Showing you a lot here. Talked about a lot. We're about to sign off here. We're going for about an hour now. I just want a little over an hour. I just want the people hit the like button, subscribe, share this with someone. You know, for anyone who has yet to experience Main Street meets Wall Street, or anyone who has not heard the podcast, not seen the channel, check it out. Come through this football season. So, you know, we got the Raiders, Panthers, you know, it's that time of year. Fantasy football is kicking off. But Main Street Heart, Wall Street Smarts. Like I said, check out the podcast. We have some really good people coming on. This one was live. We're refurbished. You'll be able to catch it later on. Main Street Heart meets Wall Street Smarts. Hit that like button, subscribe, share this. Thanks, Main Street.
Okay. Oh, is it slow? I'm gonna stay to the car and then I'll sit and then when we get the auction and then I get really though. That's where we bring it. You're working for it.
The more I watch the market on a daily basis, the more I realize, you know, markets move more on human emotions, fear, greed, stuff like that, versus what's on paper, what everyone
I did.
sees and understands. If everyone has access to the same information, then there's no real edge. If we all say, oh, hey, any stock that has a PE above 20 is overvalued, well, then, you know, I don't see
So
really
when you
the
began
edge
back in
in
2010,
that. It's all about, you know, realizing, hey, this is a long game. Doesn't matter if you're a day trader or a swing trader. You need to survive the drawdowns. You need to survive the tough market environments, because when things turn, that's when you can make, you know, your year in a quarter, or, you know, have a blowout year where you make enough money to pad your returns for several years to come.
great morning out there for everyone. Welcome back. We're tracking a massive, fast-moving macro development today that demands your immediate attention. The fragile ceasefire is officially over. Over the last 48 hours, the geopolitical chessboard completely ruptured, and the U.S. and Iran conflict escalated to a dangerous new tier. President Trump said the ceasefire, he was done with it. With the White House declaring the interim agreement finished, U.S. Central Command has launched heavy retaliatory airstrikes against nearly 90 targets inside of Iran. This comes directly against the wave of attacks on commercial shipping vessels transiting the Strait of Hormuz, the world's most critical energy corridor at the time. Right now, oil markets are spiking, regional defenses across the globe are on high alert, and the global supply chain is facing immediate shock. But as you know, on this channel, we don't just look at the headlines, we look at the bottom line. This isn't just a regional conflict, it's a direct variable hitting global energy security, corporate inputs, and future inflation metrics. Today, we're bringing on an emergency real-time 1-hour tactical breakdown where Main Street and Wall Street connect. Excited to have Gianni DePonce join us. Gianni, it's critical to have you on right now, man. How are you feeling this morning?
I'm feeling good, Marcus. How you doing?
Doing great. I'm doing great. Let's just go ahead and jump right into it. For anyone watching, let us know where you're watching from. Appreciate you tuning in. What are you seeing in the markets right now?
Well, you know, what's crazy to me is the timing of these latest developments. You know, obviously, whenever something like this happens, oil spikes, and, you know, people start talking about it. Oh, hey, you know, geopolitical stuff leading to oil surging. But if you actually zoom out, and I love to say, when in doubt, zoom out, oil is fresh off of a 4-week consecutive drop in prices. So to me, the timing is what's most interesting. I mean, you drop 4 weeks in a row in oil, you get a 2 to 3 day spike, you get this headline, and everyone, rushes to attribute it to the Strait of Hormuz. So, I'm a charts guy. I think it was a pretty logical area for oil to bounce. But, like you mentioned in the introduction, this is a pretty difficult position for the markets because it's putting pressure on bonds. That affects global liquidity in stocks and other markets. And so that's the point of fragility that I'm watching. And I'm starting to see this, create some stress in the bond market.
Yeah, and is this consistent with what you've seen with other geopolitical conflicts? Like maybe if we just go back to the Ukraine-Russian conflict a few
Yeah.
years back.
Yeah, absolutely. When you have as much debt that we have, all the developed economies in the world, the US, European Union, Japan, you look at their debt to GDP ratios, they owe more money than their economy is worth type thing. So whenever inflation spikes and interest rates go up, it means that when they borrow in the future to refinance their loans, it's going to cost more and more to do so. I mean, I think now, like, for example, in the US, from all the federal tax revenues, around 20% of that goes just to service the interest on the national debt. And so that's a pretty significant line item in their budget now. And so that's just, the normal dynamics of the market. When commodities spike, when oil goes up, it increases inflation expectations. Bond markets are designed specifically for interest rates to generally track the rate of inflation. So oil spikes, interest rates spike, bond markets sell off, liquidity becomes a bit more fragile, and then eventually that spills over into stock markets.
Gotcha. Yeah, and that just the general inflation and what people are seeing and feeling at home. Like you can have these headline numbers, you can see the data, but what you're actually feeling as you swipe these cards are really impactful. Another thing that I've noticed with the war, it seems like when it first began, everything was about the war. Like that was all you saw in the headlines every day was like the first thing in the morning, top of the morning news. It was moving the markets. Now we're seeing that push back to the second, third, fifth story. Do you think that's just kind of getting glazed over?
No, I think that there's almost headline fatigue in a way, right? And it was interesting, back to oil real quick. If you look at when oil topped out, it topped out back in early March, and the conflict didn't really settle down for another few weeks later. You didn't see that ceasefire or that truce for another few weeks. So, markets are forward looking by design. And I think that, we've played ping pong so many times, oh, there's no deal. Oh, there's a deal. The joke is like, every time there's an escalation in the tensions, we have another opportunity to reprice peace into the market. And so the markets rebound. So eventually, these announcements are going to stop having an effect. And I think that it's finally starting to catch on. The fact that stocks have, held up so well, even with the latest announcement, I think is a good thing. As a rule, when bad news doesn't lead to bad outcomes, that's usually good. Just like if good news doesn't lead to a good outcome, that's usually a signal that, hey, you need to be a little careful.
Right. And not to run too far from the Iran geopolitics, but we've seen that with earnings here recently, where bad news was good news, where you needed like exceptionally great
Yeah.
reports on your earnings for you to have actual great returns. Do you think we're getting back to a normal market area where bad news is bad news and good news is good news again?
That's a tough call on that one. I would say, yeah, I think so. I mean, the earnings season from Q1 that we had last quarter, that was the best earnings season we had in about 20 years. So we're coming into earnings season again. Stocks have rallied for about 3 months now. We're getting late in some of the cycles that I like to track. And so, yeah, I think that if you do have bad news, there is a cyclical component to leading to a negative outcome here over the next few months. However, if you get good news and it doesn't translate to positive results, then that's also, a time we're going to have to be a bit cautious.
Right. So and we're talking about geopolitical tensions, and like I said, we'll dive back deeper into the earnings. This Iran war, like the escalation since the time we set this up, is actually escalated a lot more. Yesterday, President Trump had to turn down, cut his trip short, switch Air Force Ones on the way back. Do you see any of this playing into any of the international markets?
Yes. Well, international markets have been doing very well over the last 18 months or so. So what's interesting is that this has been a theme that's been going on for quite some time. But when what starts to hit the fan, usually what you see is a rush back into the U.S. market. The U.S. market is still the safe haven market of the world. Dollar reserve currency status. When things hit the fan, people want to own dollars. They want to own dollar-denominated assets because there's more confidence in the U.S. system than any of the other ones. So, some of the markets I've been tracking closely internationally, especially in Asia, include South Korea and Japan. South Korea's, their market is their index is, I think almost tripled, year to date. It's gone absolutely insane. You have stocks like SK Hynix that have gone absolutely nuts. So, even though geopolitics are in the background, it's still, it's been an AI-driven, semiconductor-driven market. And so now at this point, because of the returns we've seen, we need to see a rotation. You need to see other areas of either the AI trade. You need to see the AI trade evolve. You need to see the tech trade, pick up some other areas of the sector. But if oil continues to spike or it starts to spike again, those countries, especially in Asia, they're a lot of they're net oil importers, and usually they're exporting their goods, right? So they don't have as many natural resources. They have to import oil to run their factories, to run everything in their economy. And so if their input costs go up, that translates to they're going to have to raise prices on their exports, and that creates a whole nother round of problems. So the Asian region is definitely more susceptible and more vulnerable economically to spikes in oil prices. And what's interesting about that is you actually, in the last week or so, you've seen Saudi Arabia start to sell oil at a discount from the market price. And I think it's because you're starting to see such wide disparities across the globe on regional energy prices, a lot of arbitrage opportunities, from regional standpoints, because, they're still commanding a premium, on that eastern area of the world because of the conflict. Meanwhile, here, in the U.S., oil prices are a bit more subdued. That's why you have the difference between WTI, West Texas Intermediate, and Brent. So that's a big thing that I'm watching, because if oil starts to spike again, it could really put markets like South Korea and even Japan on the hot seat.
Yeah, you mentioned the Kashpi over there in South Korea and Japan area. What do you think any impact of tariffs will be? If, let's just say, the president was to say, we're going to put 30% tariff over there in South Korea or Taiwan area, somewhere where we're getting major chip and memory production.
Yeah, well, it's interesting. I think that's part of a broader geopolitical alignment taking place. I mean, you look at what happened earlier this year in Venezuela and even some of the recent elections in South America. I think there's a regional realignment taking place. And I think it's also a big reason why we're trying to bring back, semiconductor manufacturing into the United States, because I don't know that the current system that exists is going to continue. I think it's very vulnerable. I think China wants Taiwan. I think China wants to expand its influence in the South China Sea and in Asia in general. And I think part of the backdoor deals that have been going on is, hey, we're going to take control of our hemisphere. You can have control of your hemisphere. And then, to each, we can each go our own ways. So I think that is a point of vulnerability. The tariff thing, I think the market is exhausted from that. At this point, you had some recent headlines with the European Union. And, that was like maybe a week or two ago, and the market kind of just shrugged that off. So, last year was tariffs. This year it's Iran. I don't know what's going to be next year, but each year there's some reason to be scared. But that's why I try to focus on the price action above all else. The market's forward-looking. The market prices in risks. And at some point, the risks get exhausted and the reward, starts to outweigh them.
Right. So what are you looking for in market prices right now? So you're looking outside of all the noise and just focusing on the actual fundamentals, or are you more of a technical investor where you want to look at the momentum?
Yeah, I'm more on the technical side. You know, when I got into the business, I was more focused on fundamentals. You know, when you're going through a lot of the programs, they push you into fundamentals. But I got into trading like in the early 2010s. So, you know, during that time you had stocks like Apple, like Amazon, you know, they weren't considered the Mag 7 or the Mag 10 back then, right? And their fundamentals weren't exactly fantastic. And so I was always skeptical. Oh, hey, what's wrong with Apple? What's wrong with Tesla? What's wrong with Amazon? Like these stocks shouldn't be going up. Their fundamentals are all out of whack. And they kept going up. And so, you know, the more I watch the market on a daily basis, the more I realize, you know, markets move more on human emotions, fear, greed, stuff like that, versus what's on paper, what everyone sees and understands. If everyone has access to the same information, then there's no real edge about that. If we all say, oh, hey, any stock that has a PE above 20 is overvalued, well, then, you know, I don't see
So
really
when you
the
began back
edge
in
in that.
2010,
So that's why I
what
think
was what
that
were some of the early
focusing on the
lessons you
price
learned?
action, the trends, the patterns, the momentum, that's definitely a first step in you know, developing an edge in market navigation.
Well, there seems to be a pause here. Gianni,
Yeah.
there you go. Sorry, it kind of faded away a little bit. Did you catch my last question on when you started trading back in 2010? What were some of the big things that you saw?
No, I didn't catch that last question. Could you repeat it?
Gotcha. The love of the joy of live stuff, man. My bad. You said you began trading back in 2010. When you began trading back in 2010, did you what were some of the early lessons you learned?
One,
You're
one more
back.
time, please.
Forgive us all. A little live TV going on. All right, Gianni, we good? Can I see you? You can see me. We're back to I didn't hear your answer. Maybe the world did.
No, I didn't
But I
hear your
can see you.
question. So let's try it again. Okay, I see you too. Yeah,
All right. You can hear me now?
yeah,
It says the device is struggling over here. Can you hear me now, G? It's frozen again.
yeah. I hear you.
Bet. All right. So my question was, you began trading back in 2010. What were some of the biggest lessons you learned early on trading?
Wow, well, that's a really good question. You know, I think that the market environment that is ongoing when you start trading can leave a big impression on you. And you know, there is a big thing about beginner's luck. So, you know, I started trading. It was the early 2010s. It was 2012 I started trading. And, you know, we were a couple of years after the global financial crisis. We were in the early stages of a new bull market. And the first year that I was trading, I had some decent success. But I almost think that's an obstacle to overcome, because when you start off in trading and let's say the market is doing well, you think, oh, this is easy, this is beginner's luck, like this is going to be an easy way for me to extract money from the market. But it's not always like that. The challenging market environments are really what define you more as a trader. So yeah, what I would say is be aware of the market environment that you're operating in, because if you're in a strong market environment and you're performing well and you're early in your trading career, it's not always going to be that way. So don't take it for granted.
You got that right. When you began trading, did you have, so like, it sounds like you had some big wins to begin. And then how did you react to those first losses? Because that's the thing with trading, you're always going to have losses.
Absolutely. Well, you know, it took me a few years to figure out risk management. That was a big thing. You know, I grew up here in Metro Detroit, not exactly a big finance culture. I never went to Chicago, never went to New York. I really learned how to trade you know, on the internet. It's very much a modern way of trading. You know, I've been fortunate enough to rub shoulders and trade alongside some guys online now that, they were in the pits in Chicago. They come from, the finance culture of New York. So, I've learned a lot from them too, but very much had a different path, an unusual path in that regard. And that's actually what enabled me to survive, because the thing is, if you blow up your account, and, I'm not proud to say early on in my career, I blew up my account, which is normal, but in this day and age, there's so much more information out there. There's so much more resources for you to learn from. Understand the math behind your strategy, understand the math behind your portfolio, because what you're trying to do is survive during the tough times. When you get back into the good times, that's when you can really thrive. And so, yeah, that's my thing is, if you blow up your account, you're out of the game. And if you're out of the game, you can't play. If you can't play, you can't make money. So it's all about, realizing, hey, this is a long game. Doesn't matter if you're a day trader or a swing trader. You need to survive the drawdowns. You need to survive the tough market environments, because when things turn, that's when you can make, your year in a quarter, or, have a blowout year where you make enough money to pad your returns for several years to come,
Yeah, you got to learn to lock in the risk. And like you said, you got to mitigate it. The market that doesn't just grow straight up to trees. What would you, and for the folks listening, there may be some people listening on the Main Street side, go into a little bit of, when you say a day trader versus like a swing trader, what's a little bit of difference in there? That's a little nuance, right?
Yeah. Well, a day trader is simply someone you're in and you're out in the same day. Usually, if you're day trading, you need to take on some leverage. Whether you're trading futures, whether you're trading, 0 DTE options, usually you need that to make day trading worthwhile. But whenever someone's getting started, I don't recommend that they start in day trading. I think you want to zoom out your time horizon. This is completely different from investing. Swing trading, you're holding positions for a few days to a few weeks, and then even position trading. That's my sweet spot is kind of between swing trading and position trading, holding trades for a few days to sometimes even a few months. If it's really working, because there's a big thing in this business: cutting your losses short and letting your winners run. And so if I identify a good setup and it's working well, I'm not in a rush necessarily to get out of that position, after a few weeks. I mean, in fact, some of my best trades, my triple digit winners in most cases, outside of leverage style trades, I'm holding for a few weeks to a couple of months. And so, usually there's 2 or 3 really good buying opportunities in the market per year. And so I try to structure those, longer holding trades around those, around those rebounds coming out of those corrections. So what I would say is, don't jump in on the shortest time interval. Give your time to adjust. Watch the market more. You'll see how the market fakes people out on one side into the other on a daily basis. Day trading's hard. I'd say out of all the traders I know, the ones that are successful are mostly not day traders. I know some successful day traders, but they're the fewest number of successful traders that I know. Most of the successful traders I know are in the swing to position trading camp. So, that's what I've experienced on in my own journey.
Right. And do you include options trading in there?
Yeah, I mean, options. You just have to look at your time horizon, right? I mean, that factors into the value of the option with time premium. You have theta decay. I trade a little bit of options. I actually prefer futures because of that time decay factor in the pricing of options. Basically, when you have the options premium, part of the value is the price of the security relative to your strike, but the other part is how much time is left before expiration. And so what I like about futures is you're not necessarily punished for, a few days of sideways action in a position, whereas in options you would be.
Yeah, options are very interesting to hop in and hop out. And then futures, yeah. Speaking of the futures are green right now as we get ready to open up this market. How would you take me through your morning as you're going to trade today? What would that look like? Like versus yesterday where the futures were very red versus Tuesday where the futures were green. So
Yeah, right.
walk us through
Yeah.
it. Take us from Tuesday through today.
Yeah. So Tuesday, we came into this week basically in some chop. The Dow hit a new all-time high on Tuesday, but on Monday you started off. Obviously, we were closed on Friday for the 4th of July holiday. Monday you came in, a bit of a holiday hangover, if you will. Tech and the Nasdaq were doing well. Tuesday you had that rotation trade in play, but yesterday and even into today, you're seeing tech and the Nasdaq start to outperform again. But, most of my work as a trader, if you want to call it my homework, actually happens after the market close. In the morning, I try not to pay attention too much to the market for the first hour and a half of trading. So from 9:30 a.m. to around 10:30 to 11 a.m., the only thing I'll do during that time is capture gains or book profits. I'm very, very rarely initiating any new positions during that time. You have to understand that, European markets, around that time are closing. You consider they're 6 hours ahead from Eastern time. So, they close around 3:30, 4 p.m. their local time. And so that's around the time that we're opening. So there's a lot of money shuffling hands. There's a lot of chaos, a lot of retail traders chasing the morning headlines. And so I try to just step back and take my shots as they come. I'd say around 80% of my trade entries happen around the closing bell. But when it comes to booking gains, I'll do that at any time of the day. And of course, it depends on the style that I'm trading. If I'm doing a swing trade versus a breakout style trade, I'm a bit more forgiving trading during the day on a swing style trade versus breakout. That's going to be, near the closing bell. So yeah, I try to pick my moments, pick my spots of when I'm initiating trades, and try not to react to the headlines, because the headlines are there to fool you into making a decision that wasn't planned. Or that's what I'm saying, my homework gets done at night. I always have a plan coming into the next day. I'm not just shooting from the hip, hey, I'm going to buy this because of this headline. No, I never do that, and I had to learn that lesson the hard way over the years.
Yeah, that's good work. Yeah, most of the hard work's done. The professional players are shooting those shots when people aren't watching, so that when it comes time to take the shot, you're ready to take it. Or if the shot's on goal, I guess we're in a World Cup season right now, whatever Messi did the other night. He can't just summon that. He can because he's done it so much, and put in the work. What calluses do you generally look at when you do your overnight work before you going into the next day?
Yeah, well, the closing price is the most important piece of data on the day. I don't really care. There's some daily levels that I watch that are, partially calculated from the high and the low of the day and the close, but I'm always looking to see where we closed relative to the previous day. And, that even applies on Friday. For me, the weekly close is very important, and even the monthly. So, time intervals, the closing prices across various time intervals, that's very important as well. So I'm always looking to see how we closed relative to the previous time interval. Did we close at the highs? Did we close at the lows? Were we at the highs and we gave back those gains? Were we at the lows and we recouped those gains? Kind of like we had yesterday, right? The Nasdaq was down all day, closed off the lows, closed slightly in positive territory, and now it's leading again. So those are the types of observations that I look for, because you mentioned that the World Cup, right? That game, Argentina versus Egypt, right? One of those things. Egypt's winning the whole game. Last 10 minutes, Argentina comes back and wins it. Well, who won the day? It's the same idea between Bulls and the Bears. Bears were winning the day yesterday in the Nasdaq. Bulls came back at the end. They won the day, and now they're up today. So never judge a trading day until the closing bell. And I think it's a very important lesson that people watching should take away from the market.
Yeah, it's good stuff. And I like how you mentioned earlier that you don't trade at the beginning of the day because of the moves inside of the European market opening or closing, I guess it's closing at that time. What about another time that I've noticed, when it's really choppy a trade, is right after, well, I guess we'll see with Kevin Wolf, but right after Chairman Powell would speak. So right before you speak, 2 o'clock to 2:30. That seems like whatever happened in that time, the opposite was going to happen for the rest of the day. If it went up, it was going to be down. If it went down, it was going to be. Do you see other signals like that inside trading?
Absolutely. When it comes to Fed Day, my golden rule for Fed days is the day after Fed Day matters more than Fed Day itself. You have all these algorithms that are coming in and dissecting every single word that these Fed chairmen say, and they're trading based off of what they say, and so it's very chaotic. And during that time, no one's forcing you to take a trade. right? Trading is the ultimate accountability profession because no one's, over your shoulder clicking the buttons for you to initiate a trade. It all comes back to yourself. It's like, it really is like having a staring contest with yourself in a mirror. That's a way that I like to describe it. So yeah, I try to tune out the noise as much as I can, focus on the price levels. And when things get a little chaotic, just step back and wait for the dust to settle before taking my shot.
Nice. Yeah. Let's talk about the Fed for a second, as you have to obviously look at interest rates when you're making trades. And now we have a new
Yeah.
chairman, Warsh, coming in. Take a look at these 5 task force and some of his new initiatives. He's only been in the chair, one meeting, I believe. What jumps off the page from his new initiatives and these task force and just the transformation coming over there at the Fed?
Well, and this might be a little controversial, but one of the things that he said that I actually appreciated is they want to dial back a little bit on some of the forward guidance rhetoric, and just, hey, we're not going to be explaining all of our policy moves as much going forward, and I think that's a good thing because you have this whole industry out there of quote unquote Fed whisperers that are always giving these inside takes on the Fed and what they're going to do. And it quite frankly never materializes. And people are always making decisions and trading around this type of stuff. And so I'm a big believer that less is more. I mean, the average person has really, aside from just looking at, where the interest rates are, you don't need to understand every single thing that the Fed is doing at every given moment. So mainly because it's all priced into the market, right? So focus on the thing that's actually going to pay you. It's like listening to the gossip and drama versus actually doing what you need to do, right? Because that's really all it comes down to. So I actually appreciated that. He has a reputation of being a bit of a hawk. I think later this year, I wouldn't be surprised if we saw some sort of rhetorical pivot. It's kind of a 50-50 now, whether they're going to raise or lower rates this fall. I know Trump wants the Fed to lower rates. But they might need to raise rates first before they lower rates. That's kind of why I opened today's session with some of the stress in the bond market that I'm seeing, because long-term rates have been rising a little bit, which in some ways is not a bad thing. It means the yield curve is steepening, the economy is starting to pick up a little bit, but yeah, there's definitely some things that are out there that the Fed needs to be careful with liquidity, because if they start raising rates again and oil prices are high, something's going to break and you're going to get a nasty sell off again. But that's part of the business. That's where the most opportunities lie, is around those corrections. So yeah, it's too early to judge Warsh. I want to give him some time. I think overall Powell did a good job, during his 10-year period, and I think Powell missed an opportunity in 2025 to lower rates, but I think that was more out of a personal spat between him and Trump. So, yeah, we'll see what Warsh does next.
Really? So you think Powell didn't raise rates or lower rates in 2025 for personal political reasons? Interesting.
Well, yeah, I mean, I don't know if it was political because Powell's supposed to be a Republican, but I think
He was
yeah.
appointed by Obama.
What's that?
He was appointed by Obama. But yeah, I know what you're saying.
Was
I
he?
know
I
what you
thought
mean. He was
Powell
appointed
was appointed under Trump.
to the Federal Reserve by Obama, and then
Oh, okay.
Trump made him chair. Yeah, then Trump made him chair.
That's right, because it was
That's what I mean.
2016. Yeah, it was after
Yeah.
Janet Yellen. But yeah, no, he is. I think he's a registered Republican. But they had their personal differences, and I think that they actually missed an opportunity to lower rates in 2025. And so now, then you had this big spike in oil. There's no chance they could have lowered interest rates, at the beginning of this year. And now oil's in limbo, and it just becomes a lot more dangerous. The last thing you want to do is cut interest rates into soaring oil prices. So yeah, we'll see. Oil coming back down now, that kind of gives the Fed a little bit of breathing room to reassess and make some decisions. But yeah, there was an opportunity missed there, and the Fed is kind of notorious for missing out on opportunities like that, either cutting too late or raising too late. That's pretty much sums up their entire history.
Yeah, that's the Fed. I mean, Alan Greenspan was great until right at the end, where he just he saw what was about to happen with that housing bubble. It's kind of like, all right, it's on to you, Bernanke. You got this thing taken over. But yeah, it's just it'll be interesting to see. What do you think the inflation? You think they'll ever get to that 2% target?
No, I think that's over. I think they're going to abandon that. I think they have to. They might change it to 3%, but I think this even ties into like what I mentioned earlier, when Warsh said, "Hey, we're going to change some of our forward guidance." I don't think they'll explicitly say anymore, "Hey, we're abandoning 2%." I think they'll just say, "Hey," I think they won't talk about it. They'll just say, "Hey, we're struggling to do this, and it's just going to be at 3-4% now, and you're going to have to live with it."
Maybe. Yeah, it could be interesting because he also in this meeting pointed that he wants to look to the, what he said, the left of the decimal now. So maybe if he sees like 2.9, he's like, we reached 2%. I don't
Yeah,
know.
yeah, 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 yeah.
Do you think we'll see any like deflationary oil prints after or inflation prints after we saw oil spike so high at the beginning of the war and then it came back down? You think we could see some deflation, like negative prints in the next couple months?
No, and I don't think we'll get negative. I think we'll get disinflationary prints, like, if we're going from 4% to maybe 3.5%, but no, the inflation's not going away.
Yeah, actually, the inflation is here to stay. Do you think it's more like a stagflationary situation at this point? I'm sorry, Gianna. What did you say with the stagflation?
No, I'm not actually in the stagflationary camp. I think they're going to try and run the economy hot. I mean, you look back historically when we've been in similar macroeconomic situations. I mean, really the only way we can manage our debt at this point is to shoot for higher economic growth. I think you're going to see eventual more deregulation, or you're going to have to go the austerity route. And that's what Europe did after the global financial crisis, and their economy has barely grown. So, the U.S. is a bit more dynamic economically. And I think our solution to the debt problem, the sovereign debt issues, is going to be accelerating economic growth. That's the only way. But when you do that, inflation is a symptom of a growing economy.
Oh, yeah. And hopefully prices can keep up, or wage growth can keep up with the price increases
Right,
that we're
right.
seeing.
That's the key. That's the key. Yeah.
I want to take a hard left here and shift into crypto. Do you look at crypto over there? Have you studied in crypto, what you're doing over there, Gianna?
Oh yeah, yeah, yeah. I've been trading crypto since about 2013.
Let's talk about that a little bit. Because there are so many people who now, you've seen the Bitcoin winner, everyone saying crypto's terrible. I had to actually did an interview with a guy. He's one of the most bearish crypto people I've ever met in my life. So like,
Okay.
what are you seeing in the crypto markets?
Well, crypto, we're in a bear market right now. We're in a downtrend, making lower lows and lower highs. People talk about this 4-year cycle that exists. It's pretty evident that there is one. So I'd like to see Bitcoin hit a bit lower prices. I'd love to see it drop as low as 40 to 45,000. But there's probably going to be some support, 53, 56,000. I'm really not that excited about Bitcoin if it's below, basically 70 to 75,000. I think you get back above there, you can start talking about a bottom. But until then, the bears are firmly in control. But when it comes to Bitcoin, my concern is, that was the trade of a generation, right? It's kind of like getting a mortgage back in 2020, right? That was a generational trade. And I think the problem you have with Bitcoin is that people have unrealistic expectations. I don't think you can expect, 100,000% returns over the next decade in Bitcoin. In fact, I'm even in a camp, and I do, I make a lot of the crypto crowd a little upset when I say this. I trade crypto. I'll buy Bitcoin at 40,000. I'll buy Bitcoin at 50,000. But similar to what stocks have experienced in the past, I'm not ruling out a lost decade in Bitcoin. And what I mean by that is that Bitcoin might not make a new all-time high for another decade. Now, does that mean you never want to own Bitcoin or you can't trade Bitcoin? Absolutely not. I mean, if Bitcoin goes to 40,000 and then rallies back up to 80, 90,000, that's more than 100% return, right? That's a nice trade. But the set it and forget it style that many people got comfortable with, you know, in the first half of this decade and the back half of the 2010s, we're in a different reality now. I mean, it's just not the same market. It's hardly the Wild West. You're not a rebel against Wall Street for owning crypto anymore. It's completely institutionalized, and that's just the way it is.
crypto, Bitcoin is definitely not the trade that it once was. Are there any other tokens or any other, like Ethereum seems
It's
to be a
okay.
big thing? Are you investing on the blockchain or any other ways? Yeah.
Yeah, I mean, I think eventually Ethereum and Solana might be interesting, but right now, Bitcoin is kind of like the tide that lifts and lowers all ships. So when we bottom, yeah, I'll probably look at Ethereum and Solana, but for now, I mean, I'm just avoiding the space entirely.
What about gold? The metals have had crazy memish moves here lately, but that's been pulled back. Is Gianni now frozen? You're back.
Yeah, I think we're setting up for a big buying opportunity in precious metals this quarter, preferably, mid to late August, September. But yeah, I don't think the precious metal story is over yet, but I do think we have a little bit more downside before it bottoms.
Got you. And then, like, are you interested in copper when it comes to the AI build out, or are you more a guy who's looking at the glass, like maybe a Corning play when it comes to the AI build out? I'm assuming that's what you're basing these metals off of, or are you just basing them on the gold as a play for against inflation and central banks? What's the whole
Yeah,
precious metal thesis
I
when you
do
mention
more
that?
gold and silver as a play against the central banks. Yeah.
Got you. What metals do you see for the AI build out? Any plays
Copper's
on
a
the
big
AI
part of
build
it.
out that you're
Silver,
seeing?
some of those rare earth minerals. I track those stocks. Those ones interest me quite a bit.
Got you, got you. And then, so another question, I guess, with your normal portfolio that you have, Gianni, what does that kind of look like for a guy like you right now? How is it constructed? You don't have to give us like individual positions, but is it like a lot of metal, probably zero bonds, and I'm assuming, just a lot of equity, a lot of crypto?
Well, actually, I do own some T-bills. I have different buckets. I have accounts that I actively trade, and I have accounts that I kind of just let ride. But I do own some T-bills in an account that I don't trade. But I still got, actually, in my active account, I got a little bit of cash on hand here. But right now, I'm mainly exposed to tech and biotech. Biotech is a sector I'm very excited about. At the moment, I think that's the next phase of AI. Even the CEO of Anthropic, Dario Amodei, seems to think that biotech is an important up and coming sector in the AI trade. So yeah, I'm hot on biotech right now. I still like tech. I've really scaled out of chips, semiconductors over the last couple of weeks. And I'm starting to look at some opportunities in the consumer discretionary, the retail space. I think that we'll be pleasantly surprised here in the next quarter or so. So we're in a bull market still. Things are looking good. You'll get dips, you'll get corrections, but yeah, in my active accounts, you are right. There's no bonds, there's actually no metals right now, no crypto right now. It's just straight tech, straight biotech, and looking for some selective
How
consumer
active are you
retail
in those
themes as
active
well.
accounts? I'm sorry, how active did you say you are? Or does it just depend on the position?
Oh yeah, no. So tech, biotech, and a little bit of cash right now.
Got you. Are you moving from software over semis now? That seems to be a trade that's moving.
I think that's a good play right now. Yeah. I think there's some value in software at the moment.
What about international versus domestic? Did you say, I'm sorry, what did you say your mix was with international versus domestic, Gianni? I'm lagging.
I'm pretty much all domestic right now.
I think I read your lips. I hear you,
Yeah, all
Ken. I hear
domestic.
you, Ken. Look, no worries. We're struggling with this screen. Yeah, domestic. I got you. American exceptionalism continues. And let's take a few minutes before we hop off, Gianni. Just tell people more about yourself, more about what you do, more about what's happening over there. Let the world know so they can find you and what you do. Can you tell the world a little bit more about what you're doing over there, Gianni? What your day to day is like, where they can find you, what's happening in your world?
Yeah, well, I trade pretty much full time. That's what I do. I'm always doing research and sharing my research with my peers and the people that tune in. But yeah, I'm all over the place. You can find me at MMA Cycles. You can find me at TheoTrade. You can find me at Benzinga. I have good relationships with all of them, and it's all about trading different markets and different opportunities, different time frames. So, yeah, you can find me a little bit all over. I got my X account at Gianni_Depoce, and I got my book Esoteric Economics that I published back in December of 2024. And yeah, just staying busy. That's the life of a trader.
The fun days, the fun life of a trader. Specific stocks that you're looking at right now, not recommendations for anyone listening. Hey everyone, welcome to another Main Street meets Wall Street conversation. Today I'm sitting down with James Callahan, industry professional, veteran. He knows a lot more about the debt than most people, the deficit about than most people. Don't get scared about what we're going to talk about. We're going to talk about debt, the deficit, ratings agencies. How do they come up with these type of things, And then we'll let James give you a little bit about himself and his history. But so with that little short intro, we'll just start out with you, James. How are you, James?
Fine, Marcus. Thank you for allowing me to be here. I'll just give everybody a brief background. I spent most of my career as a credit research analyst, approximately 19 years at State Street Global Advisors. The first 8 years were spent on the investment grade credit side, and the remaining 11 were spent on analyzing high yield debt instruments. Prior to that, I worked as a CPA. So I'm glad to be here. Marcus and I sit on an advisory board for Circa Capital LLC, and we were talking about debt, specifically the national debt of the United States on our last meeting. And so he just thought it would be a good idea to have me on and we could talk about it because it parallels individual debt in terms of it growing astronomically high and the increasing cost to service or to service the debt or pay the interest. And so we just wanted to talk about that in general, and then I guess dive into different topics that may be of interest. So, the key figure we talked about was the national debt of the United States. It's running currently at about 38.6 trillion. And that's a huge number. And, along with that, that's specifically legal debt obligations of the United States. But along with that, the other unfunded obligations of the United States include Medicare promises, Social Security payments, health and welfare liabilities. And when you look at all of those forms of unfunded liabilities along with the national debt, the latest figure is approximately $164 trillion. And that compares to assets of 5.7 trillion of the United States.
Hold
Now,
on, James. Hold on, James. Can you give me that number one more time? Give me, because I know I hear like 30 some odd million in debt. What did you just say?
yes.
100 and can you give me that one more time?
Sure, it's 164 trillion in all. That includes, Marcus, what they're including here is unfunded Medicare promises, unfunded Social Security promises, pension and retiree healthcare liabilities, and then other liabilities. And when you look at all those in the aggregate and you add in publicly held debt, now of the national debt, they're including only 28.3 of the 38.6 because that's what's held by individuals. The remaining 8 and change is held by intragovernmental agencies. So it's a significant number. And again, as I mentioned previously, most of this, with the exception of the national debt, the 28 trillion in debt, bonds, notes, treasury securities, et cetera, the bulk of that, it's not legally binding, but those relate to promises made by politicians to pay for these other programs, Medicare, Social Security, into the future. So it's a lot of money, and that's just at the federal level. That doesn't include anything at the state level or local government agency. So it's a significant amount of debt. And I think why it's important to think about this is because when we look at the individual level of debt in this country, the last number I saw was about $18.6 trillion. And that's substantial. And the bulk of that obviously is mortgages, but there's still a lot of credit card debt, auto loan debt, et cetera. And the reason why, when you think about this, the amount to service, for instance, on the individual side, the amount of income that people earn that needs to go towards servicing that debt is about 11%. And on the governmental side, to service the national debt, it's 13% and growing. These are not sustainable levels, and they're going to have to be dealt with sooner or later. But that's a very important part of the United States and capital structures for many companies and corporations. So it's important to, get a basic understanding of it and just ask questions about interest rates, credit quality, the ability to service the debt. Really important. I think for both individuals, if you can understand it at the individual level and then apply it at a larger scale level to corporations and the government, I think it becomes easier to understand or to, to sort of wrap your head around how significant it is.
Gotcha. Yeah, that's a lot. That could be scary to some folks. Some people, ignorance is bliss when it comes to those type of things. So if I'm understanding correctly, let me try to break it down in a way that, so we could say the national debt, the stuff on the balance sheet, the 28 to 35 trillion, that would be like your household debt. And then this other debt, the Social Security, which that's another thing. I thought all this stuff was already paid for, this other debt you're talking about. I thought that was already funded, right? But that was how it was intended. But this other debt is maybe like buy now and pay later type stuff. Would that be maybe a good analog to that?
Yeah, that's a good analogy. The national debt of, again, 38.6, but we'll call 28.3 of that is publicly held. So the rest held by intragovernmental agencies. So that 28.3 is basically the US's way of funding their budget deficits. The difference between what they take in taxes, the bulk of the revenues of the United States comes from taxes, individual, corporate, et cetera. And when you take the income that the United States generates and then you compare that to the spending that the US does, there's a shortfall. And since the pandemic in 2020 and the elevated spending that the US has done to sort of combat the effects of the pandemic, the deficits have been running around 2 trillion, one and a half to $2 trillion, meaning that the amount of money it takes in via taxes and other sources is not sufficient to pay for the programs that it does, 60% of which are non-discretionary and like Social Security, Medicare, et cetera. So that has to be done. But that shortfall between the revenue the revenue the government takes in via taxes less its spending requirements is insufficient. So what they have to do is they have to go out and issue debt, treasury bills, treasury notes, treasury bonds to try to make up for that shortfall. And each year that happens, each year where our spending exceeds our revenues, it continues to add to that deficit and it's growing larger and larger. And one of the consequences of that is that increases interest costs to carry and service that debt. So that becomes a bigger part of the budget. So, when you look at, say, an individual who has a substantial credit card bill, maybe it's so large that the interest that they're paying on that, they can only afford to make the interest payments. They're not afford to address the principal. So the more that they're unable to pay, the principal remains unpaid, and all they're paying is interest cost, and it eats up a big part of their income. And they could be doing other things with that, making other investments, buying or spending on other items, and so that could potentially have negative impacts on the economy. Their failure to spend in areas where they would like to, home purchases, stock purchases, etc. So servicing debt is becoming a larger and more important issue. And in the case of the U.S., we talk about in the credit space, we talk about potential default scenarios. A default is when a company that issues debt is unable to pay the debt service, the interest, or the principal itself. And that's problematic because many people lose in that case. And the U.S.'s level of debt is growing large, as is its debt service requirements. And so that is going to be a problem if it's not addressed down the, soon. And yeah, it's a very, very big issue.
Yeah, that's a huge one. So, and with the debt and deficit, this is so all debts and all deficits aren't necessarily bad, correct? It's like more so the level. Like if I go see my barber, there's going to be a deficit there because I've never cut his hair. He's always cut mine, right? But they're not all the same. But I know there used to be a level, what somewhere around 90%. There used to be like the debt to GDP ratio. Are you familiar with that? And like, where do you think we are now? I've heard it's well over 100%. Like, how does that
So
interplay in us?
yeah, so when the latest figure that I looked at, again, the United States fiscal year runs from October 1st to September 30th. So we're in the 2026 fiscal year, which will end on September 30th, 2026. So, these figures are constantly moving and they're changing because of the magnitude of them and the fact that they're not static. So when we look at the most recent GDP figure for the United States, that's the output of goods and services, it's about 30 trillion. And the national debt is running about 120% of that right now. If we use approximately the 38.6 trillion, it's not going to be accurate. Again, these figures are moving all around. So I'm just trying to use a big picture. But debt to GDP at 120% is extremely high and potentially problematic. And we'll sort of go off track here and we'll just talk about the ratings agencies that rate the debt of the United States. So the United States used to have pristine debt ratings, which were AAA across the board. And I'll cite Moody's, S&P, and Fitch. They're the three main ratings agencies that operate in the United States, and they do globally, but in terms of rating the debt of the U.S. The U.S. at below AAA is the main reasons why that triggered ratings downgrades from the ratings agencies were they were concerned about the sustainability of the debt levels. They were also concerned about they looked out the fiscal situation, things, they didn't see things getting better, or they didn't see solutions being put forth. And they also talked about the political instability in terms of the two sides in Congress being able to sit down and address these items in an amicable manner and reaching good solutions. So when you see a country coming off a ratings downgrade, that's potentially problematic because typically that tells you that now there's a higher level. Again, we're still AA, which is very, very solid, but it's not AAA. And so as you go down the ratings charts, the lower the ratings, typically, the higher the interest cost or the cost to service debt. So if we looked at, there are two companies in the US that have AAA ratings across the board. They're Microsoft and Johnson & Johnson. These two companies have strong balance sheets. They can issue debt at very low costs. And that's a big benefit. And so There's a reason why you want to have the strongest ratings. You want to have people confident in your ability to service your debt. When you issue, you know there'll be strong demand. People are comfortable loaning to you or purchasing your debt instruments. And they can look at those ratings to know that historically you've never defaulted and you're a very strong credit. Same thing in the corporate space, same thing with individuals, right? We have Equifax, TransUnion, and Experian, right? They're the ratings agencies that look at the FICO scores for individual borrowers. And for someone with a very strong credit score, say in the mid 600s to 800 category, it means you're going to be paying for your mortgage, you're going to get a lower rate. For your car loan, if you decide to get a car loan, whatever you decide to do, credit card, etc., it's going to cost you less to borrow. So the stronger you are personally, corporately, governmentally, the easier it is for you to borrow and to get an interest rate that's going to be favorable and conducive to you to be able to service it. So all around, individuals like corporations, like governments, you want a strong balance sheet because you don't want a ton of debt. Or if you do have debt, it's very important that you have the resources, whether it's income from job or assets that generate income, to be able to service it. And you want to cover that very, very strongly, meaning you have the assets or the resources. It's not like if you have a mortgage payment, say that's $1,000 per month, and maybe your net take home per month is $1,300. You have a $300 differential, and maybe you have to use that $300 for food costs, for gasoline, whatever the case may be. If you run into a problem or see a shrinkage in your income or something happens, now to service that debt, that mortgage payment, whatever it is, the liability is going to be that much more difficult and potentially put you in a situation where you have to default or, you lose something, your house or your home or your car gets taken away or repossessed. So like having a real strong balance sheet and being focused on the amount of debt that you can take on and service is really, really critical.
Yeah, knowing where you're at, knowing what you have, that's very important. And like you said, more importantly, knowing what you can spend. I think I saw a figure recently that said that Americans right now are like at over 50% of their income for their housing and total housing expense. And that's just way too high. Like you said, if you have something pop up, you don't have the margins to take care of these types of things that just pop up into your everyday life, because it's not if, it's when, right? Something's going to happen. There's going to be an event that happens. And I guess that's just kind of like why countries like the US would have got downgraded. I mean, we have, and this is a question, James, we have we have the reserve currency. I guess we had the reserve currency, right? Ever since
Right.
all this changed, we went back off of the gold standard, right? But as of recently, we see that gold has become the number one reserve currency in the world, and we see the U.S. have a downgrade rating, right? In their from AAA down to AA, or AA down to no, it's AAA down to AA, I believe. So
Yes, AAA down to AA.
in
And
your
that
days working, James, how would you, if you were sitting in a situation, how would you come to this if you were rating it and analyzing it, the U.S. as we are right now?
it's very difficult. Because of the US's track record and its ability to service debt, it's never defaulted, and it's got the strongest economy for now. These are things that are very important. The U.S. dominates when it comes to equity markets. I think we're 50% of the global equity markets. Um, it would be, I would be challenged to stick with the AA. Again, though, I analyze corporate debt, and there was a difference between investment grade and high yield. High yield, another name for high yield, was junk bonds back when the industry was first created. And so the quality of the assets, the quality of the businesses were not as strong. They obviously had lower ratings and therefore much higher interest rate costs. But, again, it would be hard for me to say, while the United States looking at everything, the AA is appropriate. I'm concerned about a number of things. And if I look at the country like I did a corporate debt instrument, especially the levels of debt relative to GDP, I'd be very, very concerned. And it would be hard for me to justify the AA ratings across the board. Now, S&P was the first one to downgrade of the three major rating agencies. S&P was the first one to downgrade the debt of the United States from AAA to AA plus back in 2011. And the other two, Fitch and Moody's, didn't do so until 2023 and 2025, respectively. And again, Marcus, the reasons why they did that, they cited big picture, rising debt, fiscal projections, and the political factors that we talked about a few moments ago. So those are very concerning. I think because of the U.S.'s history and again its economic position, it probably garners a level of favoritism from the ratings agencies that would be hard to justify for a corporation. So I'll just leave it at that. But it's has to be addressed. So when we see things in the press about interest rates and the Federal Open Market Committee and the meeting, it's really important. And even though it doesn't sound like a lot when they talk about a 25 basis point rate cut, or it's very meaningful when you consider it against the amount of debt that the U.S. has. Very, very important. And Marcus, I'd just like to back up just so your listeners have an idea. When we talk about interest rates, right, the Fed, we're talking about the federal funds rate. And that's the rate that member banks charge each other for overnight loans to meet their reserve requirements. And that's the cornerstone of the U.S. monetary policy and key driver in terms of economic activity. Everything swings off of that. So we know this past meeting, the Fed held constant. They didn't change it. They've got a Fed funds target rate of 3.5 to 3.75. And the next meeting will take place in March. But quarter basis point increase, decrease in either direction, huge ramifications again against that national debt. Now, we're not talking about refinancing all that debt because it comes due in stages, right? I think a third of the national debt is up for matures and it will need to be rolled over in 2026. That's a huge amount. And for the United States to be able to roll that over at potentially a cheaper rate goes a long way towards reducing the amount of debt service and reducing the amount expended for that and helps with that deficit situation. So we've talked about a lot of things and I hope I'm not going too far off track.
No, it's perfect.
Yeah, really important because that Fed funds rate, everything keys from that. The rates that we pay for, mortgages, which keys to the 10-year, but again, everything keys off of Fed funds rate. Credit card payments, car loans. So it's all important. It's all part of, it's all part of what consumers deal with.
Right, because I mean, you can't figure out how much someone can pay back if you don't understand the rate they're already paying on their interest and the direction of interest rates, right? If the interest rates are projected to go up in the country and it's going to cost them more money to service their debt. When we say money to service debt, and when James was saying that it comes due every couple of years, it's because this is like paper money, like short-term treasuries that he's referring to when he's saying this debt. So it's not like actual physical dollars, commercial paper, I guess is a better way of saying it, short-term money. Taking bags of dollars overseas when we service this debt. It's actually like more of a balance sheet transfer, debit and credit and credit of the balance sheet.
But for those buyers, and again, so the big buyers of U.S. Treasuries, foreign buyers, are Japan, China, and the U.K. So anyone who buys a Treasury bill, which is short term, Treasury notes, which are 2 to 10 years, and then bonds, which are greater than 10 years, they have to be paid that interest. So the government does pay that interest when it's due. With bills, you pay a discounted amount and you get the full amount back. So you buy in Treasury bills, you'll pay less than $1 million, but you'll get $1 million back, and that differential will equate to the interest earned. On notes and bonds, there's a stated interest rate that you'll collect twice a year, and to be paid out. And then when the instrument matures at maturity, you have to get paid back your principal. Those are monies that are important. And, you know, again, it's borrowing. A lot of people use the investment word with fixed income instruments or credit, like bonds and notes. But in effect, you're really loaning the government or corporation that money because they're legally obligated to pay you back and to pay you interest based upon the terms of the debt, the covenant package, the whole bit. These are things that are specific to bonds and notes. So yeah, it's just like you or I, Marcus. Like, you know, we got a car loan, the mortgage, you got to pay that each month. You're writing a check, and a portion of the mortgage is principal, and a portion